actually one of the healthiest labor markets I've seen in decades.
The overall trend is in the right direction.
Well, I have a lot of optimism that we're going to have a lot of ongoing demand for human workers.
There isn't a lot of heat in the labor market.
We think the labor market will remain choppy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's Payrolls Friday. Economists are looking for a strong number despite increasing AI concerns. As Dario Amode's Anthropic is calling for an industry-wide pause button, Sam Altman's OpenAI is reportedly considering giving up some equity to the U.S. government.
And this is coming from President Trump wanting more equity in some of the big tech companies as increasing political concern rises about what this is going to do to the labor market. Interestingly, President Trump and Senator Bernie Sanders on the same page. Senator Sanders also talking about how there should be some sort of public fund in these companies. There is a lot of concern about why the labor market is not keeping pace with what we're seeing right now in the AI space.
This used to sound like a pitch for an IPO. Our technology is so dangerous, so fast, so risky, buy our stock. And now it feels like our technology is so dangerous, so fast, so risky, regulators take us over. They've crossed the line, I think. They've got to find the balance between the right message and the wrong message going into this IPO.
And is Dario Amodei really hitting that when he says, please slow down? Everybody, just take a breath. Do we really need to have a self-correcting mechanism for AI where suddenly it can do everything by itself and strip out the human? We heard from his sister about the need for some sort of involvement of humans in artificial intelligence. The regulatory overhang is definitely going to be interesting. The bigger question, especially on Labor Market Friday, is whether we see the economy catch up to where AI is, or potentially AI catch down to where the economy is in terms of job creation that we are or aren't seeing.
Let's get to the guesses for Payrolls Friday. The jobs number later this morning at 8:30 Eastern Time. The estimate in our survey, 88K, looking for unemployment to come in at 4.3%, in line with the previous number from a month or so ago. The big number we're looking for, 125 over a SocGen. Some punchy numbers out there. We'll get into them a little bit later. So they're the jobs guesses. Let's talk about some of the headwinds for the SpaceX IPO. So JP Morgan's Jamie Dimon pitching this thing to ultra high worth clients. At the same time, we're getting some pushback from S&P about fast-tracking some of these mega IPOs, and headline crossed on the Bloomberg just moments ago that Hong Kong and China-based investors will be frozen out of this process.
There is concern about what it means to be potentially responsible. I think these are two different issues with respect to China and Hong Kong. That might have more to do with sort of the isolation of U.S. and Chinese tech. When it comes to the S&P, this is notable because it's really distinguishing itself from the NASDAQ that's saying not only are we going to fast-track you into the index, SpaceX, but we're going to increase the potential weighting of your shares in the index. You also see this from the Russell 2000. The S&P coming out, Standard & Poor's saying, you know what? We're going to stick with our rules. We have the rules for a reason. You're going to have to wait 12 months, and the weighting is going to have a cap of about 10% of total investment. And at this point, people are saying, is this good? Is this bad? Does this indicate that they're going to be the smart ones? And at what point is passive management turning into something active?
Don't hate it, kind of like it.
Totally.
Gold standard for the industry. And let's see the differences that might open up between the NASDAQ and the S&P 500 in the next 12 months.
It kind of is akin to what we see with the NASDAQ versus the S&P or the NASDAQ and the equal weight. There are questions about what exactly you're getting exposure to. You raise a question with China and Hong Kong. Who will be the ultimate buyers? And what's fascinating to me about SpaceX is how much is catering to retail investors. It's not about the indexes. It's about the fans of Elon Musk, the fanatical kind of Reddit crew that are going to be coming in with about 30% of the shares, I believe, potentially sold to these retail investors. So they're moving beyond the typical constructs of Wall Street.
Retail and these names might be stronger hands than institutional, for what it's worth. They're much more committed to the likes of Tesla and Elon Musk than maybe the institutional investors have been.
Scott Rubner of Citadel Securities said retail traders are the new price setters in this market. At a certain point, how much is this Elon Musk saying, great, you love me, you believe my story, you can set my price?
Futures this morning pulling back by just 0.4%. Coming up this hour, we'll catch up with Jonathan Golub of Seaport as Wall Street calls on the AI trade. Pierre Ferragu of New Street Research as S&P refuses to fast-track mega IPOs. And Misra of JP Morgan on the latest latest jobs report. We begin this hour with stocks struggling to extend a record-breaking 9-week winning stretch. Jonathan Golub of Seaport Research Partners still bullish, raising his 26 S&P target to 8,200, writing S&P 500 revenue grew 11.5% in the first quarter, while technology drove much of this upside. 7 out of 11 sectors delivered double-digit growth. Jonathan joins us for more. Jonathan, good morning.
Good morning.
Good to see you. Some cracks in the tech trade. Anything more than that?
This is not what the crack.
The pullback in Broadcom, the chips under pressure.
I mean, this is a company that's growing at an incredible rate, and they met earnings expectations, and the market was looking for even more. The semiconductor.
Don't you take some signal from that?
No, the semiconductors broadly grew 108% this quarter versus the quarter before. I mean, there might be things to be worried about, but a crack in tech right now is not one.
Tell us all something to be worried about, John, with stocks close to all-time highs.
Well, I mean, there's some of the spending is the cash flows on the hyperscalers have become more problematic. So if you take a look, the semiconductors are selling their chips, and the companies buying them, so they're taking the profit, and the hyperscalers that are buying them, they don't take the expense against them because they depreciate them over a period of time, and only when their CapEx projects are complete. So there's potentially some of these hyperscalers are facing more of an earnings issue, but even in that, it's not a broad-based issue. You're talking about half dozen stellar companies with great general business models that perhaps this is not going to play out as well for them.
We're talking about this delta, though, between what we're seeing in the valuations of some of these names and these companies that are coming to market, IPOing to become the fifth largest company in the world. And you start to wonder, can you see that kind of growth without participation in a broader sense from the other companies? I know that they're delivering good earnings, but it's a pretty spotty group in terms of how they're delivering earnings. And you're not seeing the underlying economy pick up in the way that you would expect. Do you need to see some sort of closing of that gap?
Well, so first, let's put valuations in perspective. The market is trading at a stock multiple of around 21, which is not overly elevated. I mean, it's high, but it's not insanely high. And people assume that if the market's going up, stocks must be getting more expensive. But if the market's going up because the earnings are going up faster than the price, then you don't have a problem. And in tech in general, these stocks over the last, let's say year to date, have gotten cheaper as they're soaring because the earnings are so good. Now, we'll see what happens with, if people are talking about SpaceX as an example and who's going to own it. If you take a look at some of these companies that are held in retail hands, like that you were saying, some of those companies trade at really high multiples, but those aren't the companies that are driving the market. And even Tesla, it's not a company with a ton of earnings. It's a company with a lot of market cap.
I guess another way of framing this is you can justify a lot of the moves and you can see the revenues in a lot of the big tech companies so far. You take a look at SpaceX and some of the projections. They're going to be getting revenues from Mars. They're going to be getting revenue. A lot of the revenue is going to come from some of the data centers that are in space. They're going to be creating a whole new reality that people are getting very excited about. And Elon Musk is a wonderful dreamer and visionary in many, many ways. But does that introduce a new risk when you start to value some of these things at 100 times over the next couple of years when you aren't necessarily seeing the revenues now at all? No,
I mean they're going to be part of this ecosystem. I mean, right now it's the hot headline, but if you look at where what their earnings are in the stack of companies in the S&P 500, they're not going to move the dynamic. The market is strong because the economy is strong overall. Like Jonathan was saying before. Every sector in the S&P is growing earnings. 7 or 8 out of the 10 of them are growing them double digits, and semiconductors are growing their earnings at 50%. And so any name coming into the market, I think, is going to have a hard time upsetting that story.
I know what you're getting at. I totally know what you're getting at. Some of the projections for the total addressable market here are like sky high. And I'll say this up front. The failure to imagine. If this was the 1990s, I've said this before about Amazon, I'd be sitting here asking the same question. Why would a bookseller be worth so much money? I wouldn't have had the imagination to think about what Amazon could have been. At the same time, in this moment, it just feels like that certain institutions are very incentivized at the moment to make sure these IPOs get away in the next 12 months.
The addressable market, the idea that artificial intelligence is a $27 trillion addressable market, some of these market shares are pretty massive. And to your point about who is representing some of the investor comment was, we're concerned, but we see that there's some really respected investors out there who believe in this. So that's actually supporting our belief in this. I understand what Jonathan's saying, that, one name isn't going to change the difference. But you just wonder, either the addressable market is not that, and this is a fiction, or the rest of the market is not changing its pricing and changing its expectation for growth quickly enough.
Something we focused on this week is constraints, whether we'd hit energy constraints, whether companies would hit budget constraints and they'd have to cut back on spending on this thing, whether the market would start to push back and we'd meet capital constraints. What kind of constraints are you and the team thinking about that are potentially on the horizon?
So, companies are raising debt to do a lot of, and I'm not talking about SpaceX, but this infrastructure, the build out, the CapEx, and there's this general belief that the AI build out is not economically sensitive. And as long as the economy is fine, whether it's a little stronger or weaker, it's not going to make any difference. Companies are going to be committed. But if we hit a real economic slow patch, if we hit a recession, and right now the odds of a recession, if you look at your Bloomberg terminal, are falling. So it's not a big risk. But companies would, if they have a choice between ultimately holding on to staff or cutting CapEx, I will tell you, they're going to hold on to staff and they're going to pull back on CapEx. I'm not saying that we're anywhere near that, but we do live in a world where economics matter, and there are enormous CapEx investments on these
That,
things.
of course, depends on the ROI of the CapEx. Because if it's the other way around, you could see something much more dramatic where they carry on investing in CapEx and they start cutting operational expenses elsewhere.
Yeah, I don't think it's that way. I mean, ultimately, if you're financing data centers with borrowed money, and some of this is, if the cost of capital goes up, if credit spreads widen, because there's a concern that I'm making a 10 or 15-year investment that I may not get paid back on. If there's concerns on that, or if the credit markets dry up, this will prove to be more cyclical than it feels right now. Listen, and you know me for a long time. I'm really bullish on this.
I know.
And Lisa and I were talking before about how we change our daily workflows to take advantage of these so we can all do our jobs better. I am not seeing companies firing workers as it relates, as much as I'm seeing people saying is, right now we need to invest in this to figure out how we're going to do things we couldn't even have imagined before. And so maybe there'll be cutbacks later on, but right now, this is a big build out.
Jonathan, it's good to see you. It always is. Thank you, buddy. Jonathan Golub there of Seaport Research Partners. Not seeing it in the data right now. We're looking for a jobs number of 80 to 90K at 8:30 Eastern Time.
You've very rarely seen the unemployment rate fall below the rate of inflation. This was a point that Michael Hartnett with Bank of America was making. There have been a couple of inflection points. They all portend some sort of financial reckoning, because it ultimately indicates that either inflation is going to be hotter or that the central bank is getting behind. And that, I think, is the logical sort of progression of where that conversation is going to go.
Unemployment close to 4, inflation close to 4. This Fed nowhere near to hiking interest rates just yet. Equity futures right now in the S&P pulling back just a touch. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The U.S. and Iran are showing little signs of progress in ceasefire talks. President Trump says negotiators are in the final stages, but Iran's foreign minister says there's been no tangible progress. The president says time is on his side. Meanwhile, SpaceX will not be joining the S&P 500 anytime soon. S&P Dow Jones indices saying it's not planning to shorten the 12-month waiting period for newly public companies. It also says it won't waive its existing requirements for profitability and public float, even for large companies like SpaceX. And Anthropic is urging AI labs to consider slowing development. The company is warning that systems are advancing so quickly they may soon be able to improve themselves without human oversight, confirming our biggest fears. That's your Bloomberg Brief, John.
Yahara, thank you. Good luck getting everyone to sign up to that. We'll discuss that a little bit later this hour. Up next on the program, eyeing a stake in AI.
I invest my heart in it and my soul because I want the country to be strong. And yeah, there will be other cases. If I have that opportunity again, I would do that. And then, you do have stupid people say, oh, that's a shame. It's not a shame. It's called business.
We'll talk about the next business move with Bloomberg's Mike Shepard down in Washington, D.C., live from New York City this morning. Good morning. Jobs number just around the corner later on this morning. The estimate we're looking at in our survey here at Bloomberg, 88K. The previous number, 115. Some pretty big projections out there on Wall Street. SocGen at 125, HSBC at 110, Bank of America around 95K. Citi sticking with their rate cut call for later this year. Citi looking for 60,000.
They're not alone. Actually, if you take a look at surveys of economists across Wall Street, they see a greater likelihood that the unemployment rate is going to go to 4.4% by the end of the year than 4.2%. I can't even believe the numbers that we're talking about and the sort of differentials. I mean, these are all fairly low unemployment rates, especially given everything else that we're seeing. Nonetheless, I actually don't know how to interpret the headline numbers. Like, I don't know what those numbers mean because I don't know what the break-even rate actually is, and I don't know how much it's going to get revised. That's why I'm watching wages. That's why I'm watching the unemployment rate.
Break-even closer to zero than maybe 100.
Yeah.
So a number like that is pretty decent, but I'm right there with you. If you want to measure slack, how tight is the labour market? How loose is the labour market? Unemployment, wages. Unit labour costs yesterday, this week, a big data point. I know for the first quarter and somewhat backward looking, but that might ease the nerves of the committee on the Federal Reserve in the next couple of weeks.
Yeah, the problem is that the data's been all over the place, right? You haven't gotten a clean read at all. Yesterday, we got the NFIB survey showing that U.S. small businesses aren't hiring and aren't planning to hire, that actually that fell to a 6-year low in terms of their plans to hire or trying to fill a job, versus the JOLTS number that showed that job openings were booming. Try to square that circle. I was having trouble with it. So you look at any of the data points, even the ISM services, you look at the headline number, oh, wow, we're doing great. You look at the employment number, wait a second, hold on. Same with manufacturing. So again, very confusing to really understand what's going on here.
Stocks are close to record highs. Alphabet just upsides its equity capital raise to $85 billion. We're going to see 3 of the biggest IPOs we've ever seen, ever. We've priced $1 trillion of IG debt in this country in near record time, and the Fed has an easing bias, with inflation close to 4 and unemployment close to 4. That's what they confront at that next meeting. Futures this morning, positive or rather negative by 0.4% on the S&P. We're down by 0.9 on the Nasdaq. Used to saying positive. We've had a 9-week winning run on the S&P 500. As things stand coming into this morning, as of the close yesterday, still positive on the week, just including this, we pull back. But you make it week 10 and you're going back to the 1980s for a weekly streak that long. Under surveillance this morning, eyeing a stake in AI.
I invest my heart in it and my soul because I want the country to be strong. I just made $10 billion or $11 billion for the United States of America. And yeah, there will be other cases. If I have that opportunity again, I would do that. And then, you do have stupid people say, oh, that's a shame. It's not a shame. It's called business.
So here's the latest this morning. Senior US officials reportedly talking with major AI companies about acquiring shares. According to reports, the OpenAI CEO, Sam Altman, spoke about the idea with members of the Trump administration. Bloomberg's Mike Shepard joins us now for more. Shep, welcome to the program, sir. I believe this report came from Notice. Can you walk us through the content of that report, whether those conversations are active and ongoing?
Yeah, I think you hit on the really key question there, is how recent these conversations are, and then how active they are and how advanced they are. And it's unclear that they have actually reached that stage of any kind of seriousness yet. But as we've heard the president say over the past year, he really does have an interest in having that kind of government hand and role in certain industries that are critical to the U.S. And there's none at the moment more essential than artificial intelligence. It's really reaching across the economy, and it's putting strains in different sectors, including energy, too. So having the government take stakes in AI companies, from his standpoint, certainly would make sense. But it is also an idea that has been pushed and embraced by Sam Altman himself. His vision, though, may be a little bit different than what the president and his advisors have in mind in terms of taking those stakes. Sam Altman has proposed in the past, and did so in a blog post in April, this idea of a public wealth fund. And that would be where companies put some of their stock into what would be essentially a sovereign wealth fund that would then in turn return some of the gains from AI to the public in some fashion, perhaps through direct distributed payments. But John, this also comes with some risks. We've seen AI drive this historic stock rally we've been talking about, the nearly 10-week streak that you just mentioned. But it also does carry some risks. If the boom does fizzle out, does the government get left holding the bag? And of course, the government would face this conflicted position, John, of having to regulate an industry that it actually owns a physical stake.
But Mike, we should be careful with language here. This is not about buying stakes. It's about taking stakes, and it's about OpenAI giving up equity. And last time I checked, that company's not a charity anymore, Shep. So if they're thinking about ceding equity to the US government, do they see the writing on the wall? Do they have visibility of what will happen if they don't do this?
I don't think that they are sensing any sort of pressure necessarily from the administration to do so, that there could be some consequence if they don't. In a way, Sam Altman does approach this from this longstanding public benefit view. He is very much into the idea of this public-private collaboration, especially when it comes to artificial intelligence. And interestingly, earlier this week, not only did he meet with officials at the White House, nobody really senior like Trump or Susie Wiles is our understanding, but he also did meet with Senator Bernie Sanders, who has a proposal very much like this. He unveiled it in a New York Times op-ed at the beginning of the week. His vision is to not only take 50% stakes in these big AI companies, but also to impose a one-time tax on their stock. Take all that money, take all those proceeds from the tax and put it into a sovereign wealth fund, again, to redistribute the benefits to the public. Now, the catch is that this proposal from Sanders is unlikely to go anywhere, but it nonetheless is a talking point, and it indicates that there is some energy and interest around this idea.
It's the starting gun for a bigger conversation, that's for sure. Mike, thank you, sir. Shep, down in Washington, D.C. Jonathan Golub of Seaport Research Partners, still with us. John, I'm sure you've given this thought. The regulatory and tax risk that might be on the horizon for these companies.
Well, first of all, the taxpayer benefits from this in that when people have capital gains, there's taxes that are levied, and it benefits society. If people are employed in these things, it benefits society. If we're more efficient in running the U.S. economy, we're more competitive versus the rest of the world, it benefits the economy. The government taking direct stakes in companies is just a bad idea. And I think the point that was made before about the government being the regulator and at the same time being an owner, they, by going and taking stake in one company versus another, they're choosing a winner. They're making an endorsement. What Sam Altman is saying is, just the language that was on the screen, because I haven't analyzed it, is choose me. How does the government then, if the market goes against the government's investment, do they then go and act differently because of that? Is that how we innovate? Is that what American capitalism looks like? And I think the answer should be no.
Well, yeah, just in that same vein, how did you interpret what we heard from Anthropic's Amade overnight, saying that he thinks everyone should just press pause, really slow down because things are getting a little scary? Is it him actually seeing things as scary, or him trying to say, can you please make our moat a little bit bigger so we can retain this gain for a much longer period of time?
Well, there's going to be pressure to regulate these activities, and there's going to be involvement. So I think to assume that this is going to remain entirely unregulated with no oversight from anyone is unrealistic. What I've seen in what industries do is hopefully they self-regulate. There's an American Medical Association. There's a CFA Society. Part of what they do is say, we will oversee some of what's going on in our world, and we will make Washington and others more comfortable that there are standards. And so I don't know whether, I'm seeing a skeptical look on this, but here's the thing. One way or another, there's going to be involvement on this. And what you don't want to do is kill what's really something which is unbelievable innovation, which can really benefit all of us.
John, it's good to see you. It always is. Don't kill the patient. Jonathan Golub there of Seaport Research Partners. That's what would regulate some companies, right? But these companies, they're talking about taking over white-collar jobs. In fact, they've been emphatic with some of those statements, particularly over at Anthropic. They're almost begging to be regulated and taken over by the government. I think it's interesting he said a button, not a pause, but a pause button. So we're not there yet, but we might be.
Yeah.
And that's the risk.
Well, we haven't gotten to the point where actually some of this stuff is full sci-fi. We haven't gone full sci-fi, full R2-D2, but we're getting there, and they want to keep it in a box. How do you do that, though, with competition around the globe? How do you do that with disparate types of players? And that, I think, is a real challenge in this time around.
Let's get China to sign up,
Exactly.
Good luck. Coming up on the programme, Pierre Ferragut of New Street Research, as the S&P says it won't fast-track IPOs. Futures negative here on the S&P 500, negative by 0.4% on the S&P. We're down across the board. We're down by 0.8 on the Nasdaq as of the close yesterday, still advancing on the week just by about 0.1%, heading towards a 10-week winning streak. Based on the price action this morning, we could snap the 9-week winning run we're on so far on the Nasdaq, down by 0.8. In the bond market, Treasuries getting interesting. The data has been decent through the week. 2s are still around 4%. 10's around 450. To Lisa's point a little bit earlier this morning, got this strange dynamic at the moment where unemployment is close to 4, inflation is close to 4, and the Fed meets in about 2 weeks' time and they've still retained an easing bias. Now, most people assume that easing bias will go away, and then it's up to Kevin Walsh to communicate what he wants to communicate in the news conference.
At the same time, most people on Wall Street still think the next move is going to be a cut, not a hike, even though you do see hiking expectations baked into the Fed funds futures. When you talk to individuals, my anecdotal experience has been most of them still think that there's going to be some sort of rate cut in the not-so-distant future. The interesting conversation is this central bank actually restrictive? Because right now, everything about capital markets is screaming something to the contrary.
Based on what we've seen in capital markets, based on the money being raised by the richest companies on the planet, it's difficult to say that monetary policy is restrictive at the moment. As we count you down to the opening bell, 3 hours away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with a massive mover to the downside, and that is Lululemon, falling 12.5% in the pre-market after it cut its full-year outlook, pointing to worsening trends across North America. And management is saying that over the past few weeks, it's seen fewer customers coming into stores, all tied to that controversy around see-through leggings. So that's not helping as it faces growing competition from the likes of Viore and Alo, just underscoring the challenges that Holly O'Neill faces when she takes the helm in September. Meanwhile, the AI chip trade is faltering again this morning, still feeling the effects after Broadcom disappointed. So you're seeing names like Nvidia, Intel, and Micron all falling in the pre-market. And the move in Micron is notable since it just scored a major win. Nvidia CEO Jensen Huang saying that it was one of the companies approved to supply the advanced memory chips for its Rubin AI system, and yet shares are down 2.5%. And we end on Quantum. This is a quantum computing stock that just went public yesterday on the NASDAQ. Shares initially rose some 13% when it began trading, lost nearly all those gains into the close. Now it's weaker again, down 3.4%, just speaking to the sour mood we're seeing around tech this morning.
Yahara, thank you. Thank you for the update. Lulu in the wrong top 10 for 2026, one of the biggest losing stocks of the year so far, down 40% coming into this morning and getting hammered once again.
Downgrading their expectation for the full look ahead, talking about how the outperformance is coming from China, of all places, in terms of their sales, and talking about having to mark down some of their current inventory to clear it out to make way for the future.
Feels like a kitchen sink from that company this morning, that's for sure. On our radar this morning, ceasefire talks between the US and Iran grinding to a halt. The president saying discussions are in the final stages, while Tehran maintains that negotiations have stalled following the worst violence in weeks. Elsewhere, Nvidia tapping the world's 3 biggest memory chip makers to supply products for its AI accelerators. The company certifying Samsung, Micron and SK Hynix for its next generation of GPUs.
All 3 vendors have been qualified. All 3 vendors are in production, and they're all racing. They're racing all to support Vera Rubin.
Deliveries for the Vera Rubin platform on track to begin in the 3rd quarter. And finally, Anthropic calling for an industry-wide pause button for AI development. The company warning it could begin to improve itself and build its own successors, and that a pause would ensure certain labs don't secretly keep working to advance the technology.
The fear here is that potentially our artificial intelligence, large language models could become self-correcting and self-generating. So you kind of take the human out and they improve upon themselves. And this is where you get to true sci-fi that I grew up on and then got me very anxious-ridden, which is the reason why potentially they're warning it. If you're skeptical, you could say they're trying to create a moat around what they're doing and potentially slow some of their competitors. Problem is, you're not going to really slow places like China where it's all guns a-blazing. Let's go. Let's see how far we can push this thing. But it highlights how we don't know the future. We don't know the iterations of what this is going to get to. And it highlights the concern among regulators as well as in the founders of some of these companies because they aren't sure what that backlash is going to look like.
This is the approach from Anthropic. They talk about big things like cutting white-collar work in half in the next several years or whatever the latest forecast is. The risks are real. I sort of appreciate that. You do too. Most people do as well. I've always felt that this was like bidding up the stock, going into the IPO roadshow, bidding up the valuation of the company. You're talking about building a moat around the company to secure its leadership position at the moment. The risk that they run is that they're regulated in the way they do not want to be regulated. Washington, D.C. moves in very blunt ways. They're not going to come up with a regulation in the way these guys want it to be. Will it be corporate taxes? They're just going to ramp that up. The Bernie Sanders position feels very extreme this morning. Might not in 12 months, might not in 24 months. Let's see how these elections go and how this is discussed in the elections, not just in the midterms, but the general on the horizon.
It's increasingly a political talking point, that is for sure. And we can't know exactly how the conversation will evolve. What's notable is when you talk to investors about this possibility, how do you prepare for regulatory pushback? Does that make you concerned? Does that reduce your valuations? You know what they say? That increases our valuations of these companies, because what it means is the winners of the past will be the winners of the future, because it will slow down innovation and potential competition. So to the degree that people look at this as a negative for these shares, yes, they might have to pay bigger taxes. They also might be the only game in town, or one of the biggest and best in town, just because it prevents innovation in other ways. So the market implication is kind of counterintuitive, potentially.
And corporate taxes just keep going up. Capital gains just keep going up.
You're in a place this morning. I can tell where you're going with this.
Society's not going to sit this out and let this rip. That's the point I'm making. And I would suggest that you look at the ports, not just in the United States, but look at the ports in Europe. Look at the control that unions have over these places. Look at the lack of technological development that we've seen, that we've had for decades. Look at the trains. The trains could be driven on their own, yet we're still paying people $100,000, $200,000 to drive these things. Why? Because we're focused on employment and the unions have a hold over Washington, D.C. I struggle to believe that they're just going to let this technology rip in the way that some of these guys are talking about.
And should they? I mean, ultimately, or should there be some sort of offset akin to what a lot of people said was the problem when there was globalization that left an entire blue-collar generation behind without jobs and without purpose? You know, should there be a real rethink of this? The difficulty is we don't understand what the ultimate goal is. And I keep going back to Pete Shear's point with the buggy whip, right? The idea that with the horse and buggy, when it came out, does it do what automobiles did to the human or what automobiles did to the horse, which was rendered irrelevant, and the population has dropped quite a bit, although they're treated very well. Are we going to be the treated very well horses, or are we going to be the human that's being facilitated by the car? We just don't know.
Horses don't get to vote. People do. And it's the political swing that you might see off the back of this that I think is the one to watch.
This is like full Animal Farm this morning.
Sure,
Welcome.
I know. Let's talk about SpaceX. A setback potentially as Elon Musk begins the company's roadshow. S&P Global keeping its eligibility requirements for joining the index, denying SpaceX and other mega IPOs from a fast track. Bloomberg's Mandeep Singh joins us now for more. Mandeep, welcome to the programme. This is a different approach than we saw from, say, NASDAQ. How much of a setback is this for that stock?
I mean, look, they have a very thin float. So from that perspective, there will probably be more demand than the supply of the stock. But they're looking to raise $75 billion, and that's a big amount. And contingent on that $75 billion is that Cursor acquisition that they have to close in the first 30 days post-IPO. And if that doesn't happen, suddenly it may not look very attractive from an investment perspective. So that Cursor acquisition is very important for SpaceX, and that index piece was key for ETFs to, include SpaceX in all of their holdings. And I would say there is definitely a setback here, but it'll be interesting to see how that thin float weighs in when it comes to the demand for the stock.
Mandeep, given the size of the float relative to the size of the potential market cap, and the potential to go into an index quickly and have all that passive money forced into it, how noisy could the first few days have been if S&P had thought about fast-tracking this IPO?
I mean, they can't afford, any let-ups here because of that Cursor deal, and they may have to end up paying a termination fee of $10 billion. So from that perspective, the capital raise, the liquidity event, is to facilitate that Cursor deal. And yes, there's that CapEx aspect around, building more compute. But to me, the Cursor deal is very paramount when it comes to the future prospects of SpaceX and meeting those growth expectations that investors have.
Mandeep, it's always great to catch up. Thank you, sir. Mandeep Singh there of Bloomberg breaking this one down. Lisa was talking about it a little bit earlier, just how much of a setback this might be. I'm going to be really intrigued to see the performance of the NASDAQ versus the S&P. Because obviously we've seen outperformance on the NASDAQ because tech is absolutely ripped, and we've got this bigger weighting on the NASDAQ 100. But how that looks like with SpaceX inclusion in one and SpaceX inclusion in the other, at least for the first 12 months, Could be interesting.
Concentration has been a feature, not a bug on the way up. Does it become a bug, not a feature on the way down? Potentially, especially if you have some of the more speculative IPOs. And I'm not saying it's speculative, but typically an IPO this big hasn't performed as well. People point to Meta. Back when it IPO'd, the years after that did not exactly, it would cast a fantastic light on it. So does this end up being a liability or does this end up being a boom?
Let's talk about Elon Musk. Looking to justify SpaceX's $1.8 trillion targeted valuation to potential investors, discussing the V3 satellite program and the company's plans for space-based data centers.
It's really just solar power plus radiator, some basic equipment for operating the satellite, and then the laser links, which would connect to the Starlink communications constellation, and then back and then to the ground. And the connection would happen no matter what the weather is.
Pierre Ferragu of New Street Research writing the forecast the consortium is discussing with investors is very aggressive, but would largely justify the IPO price. Pierre joins us now for more. Pierre, welcome to the programme. How big is the total addressable market, and how on earth do you really push back against someone else's imagination?
It's a good question. I like to think about space as being an addressable market on the growth of the global economy. And in a world in which the economy is $100 trillion, that's $200 trillion of revenues for global enterprises. If they grow, single digits every year, you actually compound the trillions very rapidly. The addressable market we see in 2045, so 15 years from now, is actually $16 trillion and dominated by telecom, data centers, and of course defense. That is going to be very, very large in space. And to that, of course, you need to add the opportunity for SpaceX of becoming like a significant player in AI, in generative AI with XAI.
Pierre, do you see any signs that they're actually gaining inroads on the AI side of the world, given the fact that so far that is a de minimis portion of the overall revenues coming from the pool behind SpaceX?
Yeah, it's a very good question. XAI is very clearly a challenger in like the frontier AI league, but they are part of their league. They have one of the best models, not the best, definitely not yet, but they have one of the best models. And they are the best at deploying very rapidly, very large-scale data centers. They have the largest coherent cluster in the world today, so they can train like the best possible models. And then if you think about like usage adoption, I think the key here is actually the acquisition of Cursor. Cursor is doing an incredible job building up like recurring revenues. They're adding in excess of $1 billion of revenues every 3 months. So they're taking like a fair share, we estimate like 15 to 20% of the coding opportunity for AI. So that's the opportunity for X to become also significant in terms of capturing the revenue opportunity in the next 30 days, because this acquisition is supposed to close 30 days after the IPO.
Pierre, a lot of people have talked about the promise of Elon Musk. We heard from Dan Ives. You're essentially buying into you're buying a piece of Elon Musk. On the other hand, you haven't seen Elon Musk capable of holding on to some of the AI-related talent in particular. There is this war for talent. You have seen a number of pretty high-profile departures. How big of a concern is that for you?
Yeah, it's always difficult to see key talents like the top 10 founders of XAI have left the company. Now, remember, Lisa, like over the last 10 years, this is the way Musk operates. At Tesla as well, you've had like an incredibly fast churn of top talents. And that's the way he has been operating for years. So on one hand, in absolute terms, always never a good thing to see a talent leaving a company. On the other side, the track record actually of Elon Musk on running extremely successful organizations with that very high level of churn is reassuring.
Pierre, is your BS radar up this morning when you hear these proclamations coming from the likes of Anthropic? When you see stuff like OpenAI ceding equity control, or at least ceding some equity to the government, having conversations about it, according to one report. I've got no idea how much weight to put on that report. But Pierre, I just wonder, what are these companies up to ahead of these major IPOs over the next few months?
Yeah, it's like, I like the idea of the BS indicator. I would say two things. On one hand, I think there is a topic, AI that gets self-improving is potentially the AI that gets out of control. Now, let's face it, the claim that we could, stop developments or take a pause or whatever at a global level is completely impossible to implement. What authority could do that? And I think more important than worrying about self-improving models, one of the competitors is raising $75 billion in the market today. And that competitor is SpaceX. And owning data centers is going to be critical. So the other two players, Anthropic and OpenAI, are very, very keen to raise similar amount of money. And as they are larger today, they need to raise even more money in order to be able to continue to spend on compute. And I guess these calls help, create the buzz for their IPOs, of course. There is an element of that. There is probably like a genuine concern there, even if it's not, it's difficult to see how they could handle it. And then last but not least, it's maybe a way to just like signal and try to slow down the pace to give it more time to continue to strengthen their balance sheet and raise more money.
Yeah, it's good to see you. Pierre Ferragu of New Street Research. Bramo's point entirely at the end there.
At this point, you got to think, how much is this them trying to create a moat around themselves when they see some of their competitors gaining clout very quickly and raising huge sums of money to really plow into their market share a bit?
Ed Ludlow said it earlier this week. The race for capital certainly feels that way at the moment. Let's give you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Ukrainian President Volodymyr Zelensky proposing peace talks with Russian President leader Vladimir Putin. In an open letter, Zelensky saying Ukraine is ready for a full ceasefire during negotiations. President Trump welcoming the initiative. Meanwhile, the Trump administration is exploring whether the government should take ownership stakes in leading AI companies like OpenAI. Senior U.S. officials reportedly held talks with major AI companies about potentially transferring shares to the government voluntarily. And President Donald Trump will be the first sitting U.S. president to attend an NBA Finals game. Trump confirmed yesterday that he'll head to Madison Square Garden Monday night to watch the Knicks play Game 3 against the Spurs.
I've been a Knicks fan for a long time, and I'm also a Jim Dolan fan. He's a nice guy. He's a competitive guy, and he's got a team that's amazing. The answer is yes, he's invited me. I'm going.
Which game have you decided, sir?
Say it?
Game 3, Game 4. Are you excited?
It could be Monday.
New York City Mayor Zohran Mamdani is also planning to be at the game. That's your Bloomberg brief. John?
Get a feeling they'll be in different seats, different tiers.
Yeah, I imagine that Zohran Mamdani will be in the nosebleed and Donald Trump will be on the court side.
Although in New York, the nosebleeds are still expensive.
All I can say is
$5,000, $6,000 get in.
If you were worried about security and the shutdown of the city, well, this is going to be one exciting time for traffic.
The wealth in this city is just ridiculous. Yahara, thank you. Up next on the program, employment holding steady.
The economy is very strong. Job growth is strong. Except for April, we have seen real wage growth every month since President Trump took office.
Up next, we'll catch up with Priya Misra of JP Morgan. Live from New York City, welcome to the program. Under surveillance this morning, employment holding steady.
The economy is very strong. Job growth is strong. Except for April, we have seen real wage growth every month since President Trump took office. We are creating jobs, and importantly, Congressman, these are jobs for Americans.
So here's the latest this morning. The May payrolls report due out in just under 2 hours' time. Bloomberg economists expecting solid growth and the unemployment rate to hold steady. Priya Misra of JP Morgan writing the job market has stabilized, but it's not a source of inflationary pressures. Priya joins us now for more. Priya, good morning.
Morning.
How relevant is this jobs report this morning to this market?
Oh, it's extremely relevant because here's what's happened. I think in the last few months, we've had data that suggests that the weakness in the job market late last year, I think we can sort of look through that. The market stabilized. Are we at the point where we may be, accelerating? Now, I think that headline number is very hard to read because we really don't know what break-even is. We're dealing with an oil supply shock. We're dealing with an immigration supply shock. But let's look at wages. Let's look at, under the hood. Is this broadening out? Is the job market broadening out? So far, I would argue that it's all very much healthcare and education. We're all getting older, some getting older at a faster rate, I would argue, like me. But I think, if it is a secular, an increase in employment, then that doesn't suggest to me that is a source of inflationary pressure. If it's broadening out, if it is services, if it's manufacturing, if wages start to pick up, then that will tell me that maybe monetary policy is actually accommodative or at neutral. I think this is why the market now, the rates market, which has all been oil driven, I think the rates market sort of sniffing out, is monetary policy actually accommodative? And if it is, then the Fed has to hike, and they don't just hike once, they hike a
Doesn't
few
the market
times.
say it is accommodative?
I think, well, it depends on what market you look at. If you're
Financial
looking at-
markets.
So, fair, but is it financial market driven by AI? I mean, is AI interest sensitive? I would argue AI is not really interest sensitive. It's this transformational technological rise in productivity, which would the Fed hiking a few times actually change that? So it's not clear. I look at interest sensitive sectors, I look at housing, I look at consumer durables. I don't see the heat there. So which is why I think the Fed is likely to stay on hold. I don't want to think that the Fed's about to start hiking, but we're going to be looking for any signs that GDP, consumer spending, is that broadening out beyond just AI and the upper part of the K. And I think the jobs market is the best high-frequency measure of that.
Michael Hartnett of Bank of America, I keep thinking about the note. He had a couple of really interesting points about the correlation between the unemployment rate and CPI and how we're entering an unusual correlation. But he also said we're seeing a wealth boom effect, not necessarily a wage price spiral, but a wealth price spiral, where you're seeing everyone's stocks go up and up and up and up, and then the wealthiest part of the K can keep spending and spending and spending and increasing the prices that they spend for things because they feel very wealthy. Is that a transmission mechanism of inflation that you have to take into consideration?
So I think if the cyclical components of CPI start to rise, if wages start to rise, then I think you have to take that into account. And this is why the Fed is sounding, look at all the Fed speak, in the, whether it's a dove or a hawk, they're all saying, well, inflation's above our target. We want to be extremely mindful of inflation expectations, wages. I hear the wealth effect argument, but, does that result in inflation trickle-down effect? Do you see rents picking up? We're not seeing that. Do you see other services picking up? This is very different from 2022, where you actually did see that trickle down. But I would argue in 2022, or 21, we had a supply shock with COVID, but you also had a demand shock. There was all that revenge travel. There was the fact that the savings rate was much higher. Consumers had that buffer of savings. Look at the savings rate. It's continuing to decline.
On the margins, are you more concerned about a reacceleration or a slowdown?
I'm more worried about a slowdown. And here's why. I mean, not slowdown into recession, but if the Strait of Hormuz doesn't open, we really need that to open. We need oil prices to come down. There's a real income shock that the lower part of the K is dealing with. And if we don't see job gains, broaden out, then I would be worried that at what point does that middle part of the K, I mean, we talk about the upper and the bottom, there's that middle, do you see them facing stress and cutting back on consumption? And so I'm concerned, and I'm not sure cutting rates actually does anything. It takes a while, and you'll need a bunch of rate cuts, and the Fed is going to be looking at the wealth effect. So I struggle a little bit more with that slowdown scenario, given how everything is so well priced for sort of perfection.
Spoken like a true bond investor. Priya Misra there of JP Morgan. Good to see you as always. Coming up on the programme, we'll catch up with Lisa Shalett of Morgan Stanley, Stephen Kirk of the Council on Foreign Relations, Gil Luria of D.A. Davidson, Mike Collins of PGIM. The second hour of Bloomberg Surveillance just around the corner.
There is no doubt that there is health and breadth in the market.
Underneath, there's quite a healthy market.
Money doesn't want to leave the asset class of equities.
When we look ahead, there are still red flags to consider here.
There is still some room for disappointment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures pulling back. The tech trade under just a little bit of pressure. Not too much, but a little bit. We're down by 0.4 on the S&P. We're down by 0.9 on the Nasdaq 100. In the bond market, set up like this going into payrolls on 2s, 10s and 30s. 2s still around 4%. 10s still around 450. Heading into this, the jobs number later on this morning. The guess is shaping up as follows over on Wall Street. The median in our survey, 88K. The previous number, 115.
Yeah, the difficulty with the headline number is we don't really know what the break-even rate is. The U.S. Pool of workers has been static or potentially even shrinking around the margins. As a result, some people saying that even a zero number could be pretty normal, the break-even rate. So a 10 to 20,000 number would be good. 120,000 is amazing. We really have to look at the components underneath. We have to look at the unemployment rate. We have to look at the wage growth to get a sense of just how much heat there is in this employment market.
We can play wait and see with the jobs market. You're not seeing aggressive tightening of the labour market that's leading to really hot wages at the moment. The Federal Reserve might be comfortable with that. But if you look at this market is just unbelievable. We keep going through the numbers. The fact that Alphabet can come out and upsize an equity capital raise to $85 billion and the stock really doesn't move relative to the rally we've seen over the last 12 months. The fact that we're going to see 3 of the biggest IPOs we have ever seen, and the debt market showing no pushback whatsoever really to these major issuers so far this year. This market's been wide open for these big players.
If you look at monetary policy through the lens of the economy, it is pretty much in line or neutral. It seems fair. If you look at monetary policy it poised against capital markets, it looks incredibly easy. It looks like it is not even close to being restrictive based on the gangbusters activity that we see. It's coming not from economic robustness necessarily, but from what people are expecting from artificial intelligence and an existential race to get capital ahead of what a lot of people think will be a completely transformative technology. So how do you understand valuations in that sphere? How do you understand exactly what the economy will do with this overlay of technology? How do you understand some of the numbers coming out of the projections of trillions and trillions of dollars of addressable market and revenues that haven't come to fruition? You know, a lot of people are saying just close your eyes and buy.
Jim Zauter, Apollo, great conversation yesterday on this program. We talked about the potential for crowding out. There's a lot of money being thrown at this. We've been worried about the deficit for a long, long time. No real consequences to any of it because you weren't seeing major issuance like we have done so far, either on the equity side or on the debt side. And now it's not just Treasury. I think the number to really think about here is you look at the issuance coming from the hyperscalers. And if you look at the capex this year, it's the equivalent to the defense budget in the US government. I think we've kind of lost track of these numbers here. And I know they're so large, so you struggle to internalize them. But the amount of debt, the amount of paper that's being issued at the moment, there is a crowding out effect you need to consider. And Jim's point was, and I thought this was interesting, that it might be more of a problem for the sovereign than it is the corporate. And that's something to track in the year ahead.
TD Securities put out a report this morning talking about the flows into bond market funds over the past week. And what you see is corporate debt funds attracting the bulk in the United States, attracting the bulk of the assets. You know who isn't? The U.S. government funds. And in general, government debt actually not seeing at all any commensurate inflows. People aren't as interested in that. And guess what? Some people are coming out and saying, is the U.S. government as creditworthy as Nvidia? Do I think that they actually can pay me back? Or do I think Jensen Huang, with his leather jackets and promise of all this growth, has a better credit profile? And ultimately, increasingly, people are saying, we're willing to pick up pennies above that government rate because we think that guy is more creditworthy.
Can I use my hands?
Please.
I use my hands. OK, so you've got credit spreads are like this, super skinny. And then they'll say to you, but I like the all-in yield. So the all-in yield looks like that. And I'll say, well, this is the risk-free. Why don't you like that? Why are you sort of interested in this? Just go to that. It's risk-free. And then you really start to get into this concept. Language is important. Just how risk-free is the risk-free? Why are they more interested in picking up that than just taking that?
And this gets to the conversation that we had initially about the U.S. economy and whether this monetary policy is easy or restrictive. Because ultimately, yes, this has to do with deficit. Yes, this has to do with growth. But if this is an easy monetary policy, then you can expect the long end of the yield curve, that risk-free rate, to go up quite considerably because people are going to have to reset their expectations for inflation.
It's got gloomy quickly, didn't it? Forgive us. We're down 0.4% on the S&P. We're still close to all-time highs. Coming up this hour, we'll catch up with Lisa Shalett of Morgan Stanley with tech driving stocks lower. Gil Luria of D.A. Davidson as cracks open up in the chip trade. And Michael Collins of PGIM previewing today's payrolls report. We begin this hour with stocks struggling to extend a 9-week winning streak. Lisa Shalett of Morgan Stanley writing, now is the time to evaluate where true secular growth may be on relative sale. Continue to reduce overbought semiconductors, favouring AI build-out diffusion over the most scarcity-priced epicenters. Lisa joins us now for more. Lisa, good morning.
Good morning.
That first line is really interesting. True secular growth. Yep. Just how cyclical do you think parts of this market actually are?
I think that the entire market is one trade, and I think right now we're in the boom part of the trade, which means the entire thing is cyclical. And I would go further than that one of the things we're pointing out to folks is, particularly in the semiconductor trade, what portion of it is price. So not only do you have to think about what are normalized earnings here, what is the fundamental underlying secular growth rate here, so how much volume goes away and how much pricing power goes away, because there's a lot of pricing power that folks are mistaking for productivity, because pricing right now for the semis are flowing right to the bottom line. And folks are looking at those margins and saying, oh my God, increase the long run forecasts. And our view is so much of this is not sustainable.
Do you think Broadcom then was just a crack or a red flag?
Probably a red flag. It's just a reminder that these businesses are really, really hard. They're capital intensive, and you can't you may be able to see your order book, but we're seeing all kinds of pressure on the inputs, right? Commodity inputs. We're seeing global commodity inflation. So I think it's a warning flag.
I love this idea that pricing power people are mistaking for productivity gains.
Yes.
How much are we seeing that with stock prices as well, in the sense that there has been a scarcity of paper for so long that there was a power of equity valuations that's getting now diluted to some degree by some of the massive IPOs that are coming to market?
Yeah, so, this is one of the things we've been talking about for a long time, and this is where we talk about PE valuations, right? And we've said to folks, look, multiples have peaked, and you're probably going to get compression. So that's why earnings power is so important. You're not going to get scarcity premium, right? And in addition, you guys talked at the top of this hour about the movement of capital. We're seeing share repurchase, which used to be a huge source of demand in this market, and it was coming from the hyperscalers, begin to go away. So all of these things, kind of put together are saying, we are now seeing an erosion of the scarcity premium. We're seeing capital that is, much more ample. It is not precious.
There is an issue right now that we keep asking people about, how much they're selling to try to buy into some of these IPOs. Like, what are they selling? Is it Bitcoin? Is it some of the non-tech related names? What do you see?
Yeah, so it's so interesting, that you brought up the crypto trade. One of the hypotheses we've had for a really long time, and, we've tried to illustrate this analytically, is the extent to which Bitcoin has been a liquidity-oriented asset, meaning when liquidity and financial conditions are ample, it rallies, and when, financial conditions are beginning to tighten, it pulls back. And I think that what you're seeing is all the folks who were in crypto simply for the speculative price appreciation are coming out, and they're chasing other things in the equity market, in semis, in potentially accessing new deals.
You think it might be a sign of capital constraints emerging, that we're seeing that move in crypto?
Yes, potentially. I think, and to your point, I think we're over the next 12 to 18 months, I think as everyone is issuing debt, as everyone is issuing stock, we're going to start to tighten up here. I also think, this idea, that you raised, Jonathan, about, is it the risk-free rate versus, the credit premium? I'm not so sure here that the overall scarcity of capital here doesn't cause that risk-free rate to go up, right? And folks need to kind of care about that, because they could say, hey, I don't care, I'm just playing for the corporate. But hey, at the end of the day, everyone's cost of capital is based off of that rate. So,
So you've got to build on that, because you seem worried about the equity piece and on the sovereign piece as well.
Yes.
That's a difficult moment to be in.
It is unbelievably difficult. So another theme that we're talking about with clients is not only, to have more realistic forward expectations about both stocks and bonds vis-a-vis history, but the need, because both of those asset classes are now tied to these same exact themes, and they are very positively correlated, that you need other things in your portfolio to be diversifiers. So it's why we've been so avid about adding real estate, about adding other real assets like commodities, energy infrastructure. It's why we've, had some appetite for alternatives. Not all alternatives, but we've had an appetite for alts because you need that ballast in your portfolio because stocks and bonds now are being, driven so much by the same exact trade.
We've been talking a lot about financial market dynamics. When does the real economy matter? I mean, how much do you actually even look at the jobless numbers the jobs numbers that come out in about an hour and 20 minutes?
So look, I think the real economy has absolutely mattered, right? We are in this unbelievably interesting moment where this technology revolution is different than the prior two. We are transforming the infrastructure and we're transforming manufacturing. Data centers are the manufacturing factories of our future. That's a great thing in terms of overall economic productivity, but it is a cautionary thing because manufacturing and infrastructure are cyclical businesses. And this brings us back to my very first point about look for true secular growth. A lot of what we're seeing in the market is not sustainable secular growth. Things that are growing 15 and 20% are not sustainable in a world where global GDP is growing 5 and maybe 7 nominal. It's just not, right? It's just not.
Lisa, a lot to think about. We appreciate it. You have a great weekend. Lisa Shalett there of Morgan Stanley. Lisa, thank you. Equity futures here pulling back just 0.4% on the S&P with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Senator Elizabeth Warren inviting CEO Jensen Huang to testify on Capitol Hill next Thursday. Warren reportedly asking Jensen to address the chipmaker's China business and U.S. export controls. We are seeing Lululemon's shares plunging 13.3% in the pre-market. The athleisure company cutting its annual forecast due to worsening performance in North America. It's facing increasing competition from the likes of Alo and Biore, while also working to recover from product missteps like its see-through leggings. And Airbnb CEO Brian Chesky is starting an AI lab. Sources telling us here at Bloomberg it's in the early stages of funding the new venture. Unlike its rivals, Airbnb has not partnered with OpenAI to create a plugin, and Chesky has said ChatGPT's tools are not robust enough. Burn. That's your Bloomberg brief, John.
Hey, Yahira, thank you. Appreciate it. More from Yahira later this hour. Up next on the program, winning one way or the other.
I think Hezbollah, I will tell you, they called us and they said, how about stopping? And I think you're going to see things happen over there. We're going to win one way or the other. It's going to be militarily or on paper.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations, live from New York City this morning. Good morning. Equity futures look like this. We're pulling back by 0.4% on the S&P 500, on the Nasdaq 100, negative by 1 full percentage point. A bit of weakness out there. Some tech-related weakness going into payrolls later this morning. Your bond market looks like this. 2s, 10s, 30s. 2 shaping up as follows. 4.04%, just about unchanged. And for crude, this is really the first time we've talked about oil all morning so far. Crude's doing nothing. Brent's at 95. WTI's at 93. We were promised on April 17th the Strait would reopen. It did not. And here we are with the 90s with no deal in sight going into the weekend.
Yeah, the reason why we haven't mentioned it is because a lot of people in markets have tried to ignore it, partly because you just can't get their handle around exactly what's going on, whether things are improving or not. That isn't to say it's not important. And actually, increasingly, people say in the next few weeks, this will be one of the most important stories if the Strait does not reopen, because we are reaching tank bottoms when it comes to some of the inventories.
Getting closer and closer. How close? We still don't know. Under surveillance this morning, winning one way or the other.
I think Hezbollah, I will tell you, they called us and they said, how about stopping? And I think you're going to see things happen over there. It would be really nice if Lebanon could have some peace. I spoke to Bibi Netanyahu about that. We're going to win one way or the other. It's going to be militarily or on paper.
So here's the latest this morning. Fighting between Israel and Hezbollah, hindering US-Iran peace talks, with Iran insisting on a ceasefire in Lebanon before accepting a deal. Joining us now, Abir Abu Amar from Dubai. Abir, welcome to the programme. Can you frame for us just what has happened in the region over the last week? Because we were looking at pictures coming from the Kuwait airport, and they looked absolutely shocking. When we're told there's a ceasefire, that's what we're told here in the United States. What do you see across the Gulf?
I mean, you guys just said it, right? We just don't know yet. And this is pretty much the same picture we're seeing out of the Gulf. But look, there are three sides to this story. There is the Iran story, the Lebanon story, and what we're hearing from President Trump. And when it comes to Lebanon, Lebanon's Hezbollah, that is the militia that is backed by Iran in the southern part of the country, came out and said that they refuse the deal that was reached between Lebanese officials and Israeli counterparts in Washington. Naim Qassem, the head of that group, actually said that the deal was absurd and that he refuses to accept it, and he refuses to accept not attacking Israel as long as Israel is attacking the southern part of Lebanon. And these attacks are not just happening in the Gulf, right? They're happening between Hezbollah and Israel. Hezbollah attacking the northern part of Israel, Israel on its own remit attacking the southern part of Lebanon and its villages. It is currently having its steepest incursion in 25 years. We spoke about that on your show before. That still continues. Those hostilities still continue. You mentioned Kuwait as well. Now, Kuwait has mentioned that Kuwait's defense ministry said that one person was killed, several others have been injured in those Iranian attacks against its main airport. They also suspended flights from the main airport into the region and pretty much the wider world. Those have not opened yet. So we still wait and see, and oil prices not doing much as investors really try to understand what is happening and if a deal is in fact imminent.
It's incredible how calm the market actually is. Abir, appreciate your coverage and looking forward to your work over the next week or so with no deal in sight right now. Just to see those pictures of a drone going into the airport, into Kuwait, and you've all seen the pictures of the damage done as well. We were playing the video there just moments ago. It's kind of incredible that we're still at this stage where we're talking about a ceasefire and these things are happening.
Yeah, Kuwait is a country that is an ally of the United States, houses troops of the United States. Where is the red line? We have heard from the president the red line would be an injured, seriously injured or killed U.S. service member. Again, though, this is really the key question. What if we cross the line to not a ceasefire?
Stephen Cook of the Council on Foreign Relations writing the following. The president is looking for a way out. He seems to have lost interest. The Iranians are also playing for time while watching the US political clock. Stephen joins us now for more. Stephen, welcome to the programme. Peace through strength. It's a lesson, something that the Biden administration didn't seem to understand, and they were criticised for it repeatedly by this administration too. Stephen, do you think the president and this administration has forgotten that lesson?
Well, it certainly seems clear that the president is not interested in escalation. He has threatened the Iranians any number of times only to back down. And he has informed aides that he has no intention to restart active combat against the Iranians unless an American soldier is killed. That's not a good negotiating position. That does, by taking the gun off the table, the Iranians know they can do things like hit the Kuwait airport. They know that they can demand a full Israeli withdrawal from Lebanon, which is essentially stalling for time because they know the Israelis are not going to withdraw from Lebanon until Hezbollah is disarmed. So I think the president in some way has lost his interest in this. He, in fact, called negotiations with the Iranians boring and is done. And so, therefore, the Iranians are given a permission structure to do the kinds of things that they're doing.
Stephen, is it that simple, or is there some other constraint around perhaps escalating this conflict, whether it's allies in the region that are saying, please don't create another regional all-out war? Is it some of the pushback from his own political party? Or is it the idea that ammunition supplies are limited in the United States and there is an effort to rebuild?
I think those are all good points. In particular, the allies in the region, some of them in particular, are quite concerned about their energy infrastructure. And we are starting to run low on inventories, which will cause more pain for the American people. At the same time, the president cannot talk about winning the conflict. The president cannot talk about all of the damage he has done to Iranians to Iran when we're looking at a situation in which the Iranians continue to enrich uranium, where the Iranians have some control over the Strait of Hormuz, and the Iranians can threaten their neighbors like Kuwait at will.
There's a huge political issue coming up as we get to driving season and as we do approach tank bottoms, as we've heard from people, including Michael Worth of Chevron. At what point do you expect the Congress and the White House to potentially restrict sales of U.S. oil and gas to places like Europe to try to keep down the prices here in the United States?
Well, we've already heard some calls to that effect, that said the oil and gas should not be exported to Europe. Of course, that then creates very significant problems for the Europeans, which will also be a problem for the U.S. economy. So this is this kind of situation in which every day we're getting closer to an agreement, when we're in fact not getting closer to agreement. And kicking the can down the road is in fact making things worse. And so the economic situation will grow worse and worse as time goes on, with the president unwilling to make any kind of decisive decision. Either he finds the political will to accept the fact that he will sign an agreement that empowers the Iranians and somehow tries to spin it, or he'll have to escalate in order to open the Strait of Hormuz.
The phrase we often hear as well, Stephen, from the administration is Operation Economic Fury, that the squeeze we're putting on the Iranians will force them to make concessions. What's your view on that? Because we've had the squeeze on the Iranians from an economic angle for quite a while.
Yeah, there is one interpretation of what the president is doing, which is that he is hanging tough and he believes that the blockade will eventually collapse the Iranian economy, and that will lead ultimately to the collapse of the Iranian regime. I think what's missing from that analysis is the willingness of the Iranian regime to inflict pain on the Iranian population, and that they believe that they can outlast the president, who is looking at a political clock here in the United States where the midterm elections are coming up, and we're getting towards that part of the political season where it really matters what's happening in the economy.
Steve, it's good to see you. As always, Stephen Cook there of the Council on Foreign Relations. Midterm still feels like a long time away. And I understand why some people have started to ignore this, because the market has as well. The market's parked this. The market's parked this because there is a belief that the president doesn't want to re-engage in hostilities. But the Iranians are also aware of that commitment to not re-engaging in hostilities. And to Stephen Cook's point, he alluded to it, that's emerging as a bit of a weak point in negotiations.
That's sort of why you're seeing some of these missiles fly into places like the Kuwaiti airport, because they can. And they can continue to attack and have missiles fly without violation of the ceasefire. The point there that he was making, though, at the end, in response to your question, a really important one, the idea that the Iranian leadership is willing to inflict a lot more pain, especially if they know that the pain is going to get a lot more seriously, potentially problematic for this president politically.
They don't have the midterms coming up, let's put it that way. Coming up on the programme, Luria of D.A. Davidson on the cracks opening up in the chips trade. From New York City, you're watching Bloomberg TV. The jobs number is 60 minutes away. The estimate in our survey, 88K. The previous number, 115. 3-month moving average coming into this around 120. So things have started to pick up in this economy based on the jobs number so far. How tight is the labour market? To Lisa's point, you've got to look at unemployment. You've got to look at wages, and we'll do just that in about 60 minutes' time. Equity futures on the S&P pulling back. The tech trade just giving up a little bit. We're down by 1 full percentage point on the Nasdaq 100. Not just Broadcom, but maybe some other red flags starting to appear in this market.
Yeah, people are getting a little bit nervous about the supply coming to market, given that a lot of it is starting to feel like it's crowding out potentially other trades. How much are people selling certain things to try to get in on the SpaceX IPO that's coming, and then the OpenAI and Anthropic following that? Ultimately, this is going to be a key question, and I think Lisa Shalett nailed it. At what point are these all cyclical trades? And if you get them kind of experiencing some weakness, if you don't get an economy that really moves in tandem with its strength?
It just feels like one big trade, to Lisa Shalett's point a little bit earlier. In the bond market, 2s, 10s, 30s, going into that jobs print, yields this morning, unchanged around 4% on 2s, around 450 on 10s. This will set the tone for the one part of the dual mandate over the Federal Reserve. The other report, which is on Wednesday, the CPI report, will set the tone for the other part of the dual mandate heading into the Fed's meeting in just under 2 weeks' time.
So the expectation for today is the unemployment rate stays at 4.3%. If it moves down to 4.2%, it would be in tandem with the expected CPI rate that we would get next Wednesday of 4.2%. Just to give you a sense of where we are, it is very rare to see the unemployment rate and the inflation rate come in at the same or the unemployment rate being below. Raising questions again, is this Fed really restrictive or potentially accommodative?
As we count you down to that jobs report and CPI next week, of course, let's get you some single names. Some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Lululemon shares absolutely plunging this morning, down 11% in the pre-market after it cut its full-year outlook, pointing to worsening trends across North America. And management saying that over the past few weeks, it's seeing fewer customers coming into stores. That's due to controversy around some of its see-through leggings, and that's not helping at a time when it's facing growing competition from the likes of Alo, Viore, Rhone, and name just a list of others coming after Lululemon. Meanwhile, as you said, we are seeing the chip trade falter again this morning, still feeling the effects after Broadcom disappointed, or as Lisa said, maybe taking some chips off the table as we get ready for the SpaceX and all those other IPOs. But meanwhile, we are seeing Micron, Intel, and Broadcom all falling in the pre-market. And the move in Micron is notable since it scored a major win. Nvidia CEO Jensen Huang saying that that's one of the companies that's been approved to supply the advanced memory chips needed for its Rubin system. And in a down market, sour on tech, I did manage to find some positivity, and it is no other than the space sector. In anticipation of that SpaceX IPO, these stocks have seen an incredible run-up. Rocket Lab up some 50% over the past month. AST Space Mobile up over 60% in that time. John.
Yahira, thank you. Thank you for the update. On our radar this morning, the payrolls report due out in just about an hour. The median estimate in our survey calling for 88,000 jobs added and the unemployment rate to remain unchanged. A slowdown could hammer bond traders betting on Fed rate hikes in the next 12 months. Elsewhere, Trump officials clashing over potential loopholes in China tech restrictions. A potential shift in policy may have legally allowed firms like Alibaba to buy Nvidia chips overseas. The Commerce Department insisting global bans remain in effect. And Elon Musk joining the JP Morgan boss Jamie Dimon pitching the historic SpaceX IPO, Musk laying out plans for deploying data centers into Earth's orbit.
We don't think this is a particularly difficult thing to do. In fact, we think it's easier than our communication satellites. The Starlink V3 communication satellite is an incredibly complex machine. The AI data center would be much simpler by comparison.
SpaceX pricing its share sale at $135 per share, raising roughly $75 billion. Quite a scene in the last 24 hours at the new JP Morgan headquarters over on Park Avenue to see Jamie Dimon, the most well-known man in finance, pitching the biggest IPO we've ever seen with the richest man on the planet to send rockets into orbit and data centers as well. Just pretty remarkable pictures for this market, for this economy.
This is incredibly rare. We just have to put that out there for the top banker, arguably in the world, or certainly in the United States, to come out and stand alongside Elon Musk and say, this is a good investment, this is a great investment, this is the future. And what it's doing is it's increasing enthusiasm among retail investors, wealthy individuals, and beyond, that you have some of the biggest personalities in finance supporting this. I was looking at some of the commentary coming from family offices. One, he's very prescient and a futurist, talking about Elon Musk. I'm a believer in what he does. She also said that the event shored up confidence because it, quote, showed a lot of very serious people backing his venture. This is unusual to see people really putting this forward, and there's an incentive to do so because ultimately they've got a lot of money at stake and they need to sell a lot of paper coming into a market at pretty high valuations.
And if this IPO goes well, sets up the next IPO, the IPO after that, could set the stage for a lot to happen in the next 12 months.
There is no incentive for bankers on Wall Street right now to talk this down.
None at all.
Unless they don't have a piece of it, and then you've got Jeffries looking to take the other side of it. But, right now there is an incentive to get this out and to celebrate this. And it might end up being a real positive in terms of what these companies promise. There is a risk that this is one big cyclical trade, to Lisa Shalett point, that you can't see growth rates at this pace, especially if you don't see the rest of the economy gaining steam, and that you might see some faltering performance as you typically do after big IPOs in the initial years.
There are many incentives to keep this rally going. That's for sure. This rally coming undone just a touch. The massive run for semis taking a bit of a breather as potential cracks emerge. Broadcom leading the retreat, adding to losses after raising over $280 billion in market value. Gil Luria of D.A. Davidson remaining neutral on the stock while raising his price target. He writes the following: "We found out how on edge investors are about technology. If the beat isn't big enough, the consequences were severe. Value is shifting quickly as the bottlenecks emerge." Gil joins us now for more. Gil, welcome. Lisa Shalett called it a bit of a red flag for the semis trade. Do you consider it a red flag or just a small crack?
A small crack. Let's not forget, Broadcom just grew revenue 50%. It grew its AI revenue 143%. So it's a very good result. But investors had now been trained to expect a lot more than that, because some of the upside results from companies like Intel, AMD, and Dell were so spectacular that investors just raised their expectations too much. You're talking about a cycle, and semis are always a cycle. This is not any different. None of us know how long the cycle is going to last. We all speculate and estimate, but it could last through next year and it could last through 2030, and those are very different outcomes. What we do know is that different stocks are trading differently on that cycle. I would argue that companies like Intel or even AMD and many of the optical stocks and the nuclear stocks are trading as if the peak of the cycle isn't until 2030, where stocks like Nvidia and Micron are trading like the peak of the cycle is next year. So that's where we see the opportunity in betting on the ones that not a lot embedded in the valuation. Nvidia at 22 times, Micron at 10 times, look a lot safer than Broadcom at 35, AMD at 40, Intel at 100 times. And that's where we see the opportunities, because there is going to be a cycle. We just don't know how long it's going to last, because the developments in AI are so rapid that it's very hard to predict when we get to peak functionality, when we get to quicker adoption. So we have to play the cycle carefully by going to the less demanding valuations.
There's also a degree of uncertainty, Gil, about the addressable market, and that clearly was put on display with SpaceX and some of their projections. And maybe as what's at stake with Nvidia as well. I mean, is this an issue of people saying that the peak might be next year, or is it people saying that the run rate just cannot continue at the pace that it has?
Yeah, two sides of the same coin. We look at the hyperscalers. They're spending most of their operating cash flow. Google just went out and raised $80 billion of capital. By the way, think of that as coming on top of the capital demand from SpaceX, Anthropic, and then OpenAI. You also have Google going out for that much. Next, you'll have Amazon, Microsoft, and Meta going for more capital. So the capital demands on the market are impacting the stocks already. And if the hyperscalers raise that much money, they can continue to raise their CapEx rates. They do see this as a good return on investment. I know that's a controversy. It's not for them. They are growing revenue at an accelerating rate at the same margins. That indicates a good return. To the economy, you can see the return from the run rate of OpenAI, Anthropic, and Google's products. Those are products that are being bought by consumers and businesses. That's real economic value. And right now we're at more of $100 billion run rate. So there is return. We do expect these hyperscalers to continue to spend. But again, part of that's going to come with more capital demand, which is going to have even more of an impact on stocks as they sock up the demand, combined with those IPOs doing the same thing. So that's a lot of volatility ahead from all these directions.
At what point do the semiconductors lose pricing power? At what point do you have some of these companies, and frankly, their creditors pushing back and saying, I'm going to lend you $10, and then they're going to charge you $20, and then you're going to ask for $10 more, and then you're going to ask for $30, and then it's going to keep going up. I mean, this is what it feels like, an auction house. At what point do a lot of the hyperscalers say, enough? Stop it already with the price increases. At what point does that leave them potentially with some capped margins?
The hyperscalers don't have that many options. They are still, by and large, relying on Nvidia chips almost entirely. That makes Nvidia's gross margins around mid-70s relatively safe. Now, they're going for alternatives. They're trying to make their own chips with Broadcom, and they're trying to ramp up production at AMD. But those are still at very early stages, and those are coming in the mid-70s. So right now, those are the only options. So the hyperscalers are not necessarily in a great negotiating position in that regard. So that makes those semi margins relatively stable. Even in memory, the supply is just not there. So those companies can be in the high 70s even. How long that lasts, again, is a matter of how long the cycle lasts. But right now, it looks like it could last through 28, 29, 2030, which for most of our investors is their investment time horizon, and they can be comfortable with that. But again, that's only if AI continues to progress. If diffusion of AI happens into companies that generate productivity from that, if consumers are willing to subscribe or are willing to accept ads in their chat, only if those things persist will the hyperscalers continue to invest and keep the margins high at those semi companies.
Hey, Gil, it's good to see you. Appreciate your time as always. Gil Luria there of D.A. Davidson. In the meantime, it's quite a wealth transfer, a major historic wealth transfer from hyperscalers to chips at the moment.
This feels like a kid playing their grandparents against each other to raise more money, and then somebody on the other side who's selling the games that they want just keeps jacking up the prices because they know that they're playing the grandparents about who's going to love me more. I mean, at a certain point, you just wonder when people are going to say, am I going to really keep you giving me more money in order for you to give more money to the semiconductors? I don't know.
It's quite a scene, isn't it? We're down 1% on the Nasdaq this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Jane Street is planning to build and finance its own data center to keep up with growing demand for compute power. Sources telling us here at Bloomberg, the market-making firm is talking to companies in the technology, crypto, and finance industries about building a facility. President Donald Trump saying that recently named Director of National Intelligence will only serve in the role temporarily. Trump's appointment of Bill Pulte for the role earlier this week drew bipartisan backlash. Pulte is also remaining in his current role as director of the Federal Housing Finance Agency. And President Trump saying he will headline a rally in Washington on June 24th to mark the 250th anniversary of the U.S. At least 5 of the 9 announced performers dropped out of the event, saying it was way more political than they were led to believe. In a post, the president writing, "We don't want singers with no talent. We've told them all to stay home." That's your Bloomberg brief. John?
I like how the 250th anniversary has turned into a rally for the president.
Well,
he's not even hiding it anymore.
No, it's just, right? It is what it is. I mean, I don't know what to say about this one.
Yahara, thank you. Appreciate it. Up next on the program, stabilizing the labor market.
The economy is very strong. Job growth is strong. Except for April, we have seen real wage growth every month since President Trump took office.
Up next, we'll catch up with Michael Collins of PGIM, live from New York City. You're watching Bloomberg TV. The jobs number in the next hour, the estimate in our survey, 88,000. That drops at 8:30 Eastern Time. Your equity market into that, negative by 0.4. As things stand at the close yesterday, still just about on course for a 10th consecutive week of gains. If we hold on to these numbers this morning, though, we'll undo that 9-week winning streak. On the Nasdaq 100 this morning, down by 1 full percentage point. In the bond market, shaping up as follows, 2s, 10s, 30s. Yields look like this, just about unchanged at 4% on 2s. Under surveillance this morning, stabilising the labour market.
The economy is very strong. Job growth is strong. Except for April, we have seen real wage growth every month since President Trump took office. We are creating jobs, and importantly, Congressman, these are jobs for Americans.
So here's the latest this morning. Payrolls dropping in less than 1 hour. Our survey calling for an increase of 88,000 jobs in May. Michael Collins of PGIM writing, the labour market remains on relatively stable footing. Other data suggests an ongoing low churn environment. Mike joins us now for more. Mike, welcome to the programme, buddy. It's good to see you. Let's talk about this jobs market. How hot are things right now? Looking at this market, it looks red hot. When you look at the economy, do you see something different?
Yeah, the job market, I wouldn't call it red hot, Jonathan. The job market has stabilized, right? The last couple of quarters, we've been talking about kind of a slowly deteriorating or moderating job market, but I think you can kind of throw that narrative out for now. It seems like things have certainly stabilized. Even breadth, as we look at, job gains across different sectors, seems to have improved a little bit. Manufacturing sectors in general are actually doing fairly well. A lot of that is just riding the back of the big AI CapEx boom, as you discussed earlier in your show. It seems like one big trade, right? And then that's one thing that really does bother me. We saw this during the housing bubble in 05 and 6 and 7, where the whole economy kind of rides on one big sector. When you have so much CapEx going into one area, you tend to have so many companies kind of channeling their business toward that. And then the wealth effect, of course, is also part of that same big trade.
Mike, do you think that the Fed has the luxury of waiting to see how this plays out? Does the new leadership have the luxury of time?
Yeah, I mean, I think they're just on hold indefinitely right now, Jonathan. I think the hurdle to hike is a lot higher. I know more and more FOMC speakers are talking about maybe considering a hike as the next move, but I think the hurdle for that is very high. I think ultimately the next move will be a cut or two. It may not be for a year, though, right? So I think we're kind of stuck in this interest rate. You look at rates right now, as you mentioned, they're totally unchanged today, which is really kind of unusual. Interest rate volatility has come down. We've really been stuck right now in a very tight range across the entire yield curve. And that's not a bad environment for the economy, because the economy seems to be running pretty well with rates at these levels. It's not a bad environment for fixed income investors, my clients, because they're earning these what I consider to still be really high yields, really attractive all-in yields for longer.
Is there any sign right now to you, at least in capital markets, that monetary policy is restrictive?
Yeah, I mean, so the problem with monetary policy, Lisa, right? It's not restrictive for the big companies that are borrowing money like crazy. It's not restrictive for wealthier people who benefit from receiving the interest from these high rates. But man, it is restrictive for a huge growing percentage of the population who are really struggling with high interest rates, whether it's on trying to get a mortgage or on car loans or financing big ticket purchases. My analysts are telling me every day that they're seeing kind of cracks really starting to form and spread out through big ticket items. Think of, RVs and things like that. And you talked about Lululemon earlier. Maybe that's just an affordability issue, but it is happening, right? So when you think about the Fed, like, what is their real goal? Is it to manage the economy on average, or is it to support, the 80% of people who are struggling with high interest rates, right? And that's really the challenge that they have, and why it's a very difficult position for them to be in.
Would you change your view if you did see the unemployment rate fall to 4.2% today? I know it's not a base case of many people. The expectation is 4.3%, but if it were to be 4.2%, that would be in line with the expected CPI print next Wednesday. And it is very unusual to see these two things come in tandem. Would that be concerning to you?
You mean in terms of the Fed considering to hike rates and
needing
the labor market overheating and inflation going too high? I don't know. I mean, I think, again, the problem with the Fed, right? They have a very blunt instrument, right? The monetary policy tool, and it really controls the demand side, obviously much better than the supply side. All the inflation we're really seeing is supply driven, right? It's not, other than the AI CapEx thing, which is driving prices higher on a lot of specific goods. But it's really a supply problem we have in the economy. And I think that's going to get worse. So by hiking rates, the Fed actually reduces the supply, right? Because it makes the financing of new equipment and new manufacturing more expensive, right? So they're kind of in a quandary here. And we're not seeing I'm looking at the wage growth, right? More than the unemployment rate, Lisa. If you, obviously, as we discussed last month, if you look at the hours worked times the wage increases, they seem to be kind of moderating a little bit. Like we're in a disinflationary wage growth environment right now. We've gone from wages growing, 5-6% a year to about 3.5% now, and that number has continued to come down. So that's a really important number to watch this morning.
If your argument's going to move on 10 basis points, you don't have much of an argument to begin with, Bramo.
Okay, fair point.
10% down, 10 basis point downside surprise and unemployment.
It's not that it's not that. That's sort of a historic metric. That said, the pace of the decline and the strength that you're seeing in certain metrics of the employment market in tandem with where CPI is at is getting some people nervous. I'm not saying it's definitely going to happen. I'm not saying that it's going to change the needle. I just think it's an interesting metric to look at.
One final question for Mike Collins. Mike, I want to give you a shout out. This is your last appearance on Bloomberg Surveillance. I know you're retiring. And I wanted to say thank you to you, sir, because when I moved here more than 10 years ago, you were so kind to me. And I've learned so much from you and the team. And I consider the work that you did with Robert Tipp and Greg Peters over the last decade in fixed income just to be absolutely phenomenal. I have one further ask of you. Mike, can you just share some wisdom with us? Career lessons, the number one career lesson in this fixed income market going into a massive technological revolution and all the change we're seeing taking place.
Yeah, I mean, this is a really interesting period to be living through, right? Even as my career is coming to an end, it's something that I will certainly be involved in for decades in terms of participating in this AI revolution, right? And AI is a great tool for everybody, right? There were stories on Bloomberg this morning about, this, people getting $60,000 a year, of income, even though they're not working, right? I mean, so productivity is a miracle. It's like the holy grail for economists, right? And it seems like we are seeing and going to see some productivity improvement. But we've seen this before. I've seen this so many times over my 40 years, Jonathan. When you have this much investment, excessive investment, I would call it, in one area, it becomes such a huge part of the economy, and it drags a lot of companies and a lot of businesses into that same big trade, and it doesn't end well, right? So I'm very cautious and concerned about the actual return on investment of all of this giant CapEx. And again, we've seen it so many times, and it doesn't work out well, right? So,
Mike, I'm not cautious and concerned about your retirement, though, sir. Not in any way, shape or form. Mike, appreciate your time. Thank you for everything you've done, for being a friend of this program.
It's actually one of the healthiest labor markets I've seen in decades.
The overall trend is in the right direction.
Well, I have a lot of optimism that we're going to have a lot of ongoing demand for human workers.
There isn't a lot of heat in the labor market.
We think the labor market will remain choppy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Negative 0.5% on the S&P, pulling back just a touch. On the Nasdaq, a little bit more. We're down by 1 full percentage point as some cracks begin to emerge in a tech trade. We'll get to that in just a moment. In the bond market, 2s, 10s, 30s. Yields shaping up as follows going into payrolls. 10s around 4.50, 2s around 4%. The guesses this morning, the jobs guesses are pretty elevated. We're looking for a number close to 90,000. On jobs, SocGen a punchy 125. Some momentum starting to build in this labour market. Does it continue with this report?
This is a confusing labor market, and so you'll get a lot of people who are going to be looking at the details of this. We've talked about wage growth. That's going to be key. We're talking about the potential unemployment rate. That also a potential gauge of strength or slack. A real question also going forward of the composition of those jobs. Are they coming from education? Are they coming from healthcare? As Priya said, we're all getting older, some of us getting older faster than others, and that we need to be taken care of. And at a certain point, is that the right kind of job growth that you want to be seeing?
Looking ahead to that payrolls report at 8:30 Eastern time, and looking ahead to this as well. A major IPO set to take place in the next several months. SpaceX coming to market. Jamie Dimon of JP Morgan pitching this to investors, and we're starting to see some headwinds building. Just a couple, not too many, but the fact that S&P is sticking with the seasoning period, not fast-tracking these mega IPOs, one. And two, the headline that dropped earlier on this morning, that Chinese-based investors, Hong Kong-based investors won't be able to invest in some of this? Just on the margin, something to pay attention to.
Yeah, the ongoing bifurcation between the U.S. and China when it comes to their tech stacks, and how much there are going to be barriers between the two, and a question about how much Chinese companies can buy some of the U.S. chips. We've seen that with Nvidia as well as U.S. tech products. Look, there is a bigger question here. Who is going to finance this mass capital raise? Right now with SpaceX, you see every banker lining up to try to pitch it to their clients, an increasing proportion of retail clients that possibly are the price setters of the future, as Scott Rubner of Citadel was saying. And you see a question of, what do you sell to get into this? Do you sell Bitcoin? Do you sell other tech names? Or do you sell the rank and file of the economy that are not hinged to this massive cyclical bet? There is a clear anxiety there, and that is evidenced by how much of a sales pitch is being made across Wall Street.
Mike Collins, some word of wisdom, from PGIM, retiring. What did he say? One big trade, and these things never usually end well. Something to think about.
At the same time, and pretty much everybody says this, right? It will end. But it might not end for a while. So if it's not going to end for a while, you are going to get penalized for missing out on it. And this is the conundrum for a lot of investors.
Coming up this hour, we'll catch up with Nadia Lovell of UBS. With a 9-week winning streak under pressure, Becky Frankiewicz of Manpower Group expecting a slower pace of job growth, and Jeff Rosenberg of BlackRock reacting to the Payrolls print. We begin this hour as investors pull back from the tech trade heading into the latest jobs report. Nadia Lovell of UBS writing, stay positive but diversified. We will like the AI value chain, but we think leadership broadens from a narrow set of mega caps. Nadia joins us for more. Nadia, good morning.
Good morning.
What drives the improvement in breadth?
I think you continue to see, as you've been talking about the AI trade, I wouldn't say that it's broken or any sort of cracks. It's more of a scratch, right? Particularly given what's happened this week. But in terms of how we're thinking about it, we continue to think that diversification across the AI value chain is quite important. We've been squarely focused on where the bottlenecks are and invested in those areas. So think about memory, think about compute, think about networking, think about software platform. And so despite the fact that you're seeing some weakness today, we do think that ultimately what's going to drive this market higher is going to continue to be the AI trade.
The AI trade and the earnings that it's created. We mentioned it a bit earlier, a bit of snark, but I'd love your reaction to it. Whether we're just seeing a massive wealth transfer from hyperscalers to the chip players, and that's all the earnings story has been so far. Is it more than that?
It is more than that, right? Because the demand is there. That's also driving the pickup in the hyperscaler spending. I mean, we know that this year that the 4 largest hyperscalers have already earmarked over $700 billion in CapEx. We think that global AI CapEx is going to be over $800 billion. And then we think that that gets to close to $1 trillion. And even those estimates might prove to be conservative, just given the capital raises that we're seeing this week and the announcements around Alphabet and so forth. And so we could potentially see even more of those kind of announcement coming from the rest of the hyperscalers, and that's going to push up the CapEx numbers even more. Again, there's increasing demand from the enterprise. You're seeing AI move from sort of an experimental phase and more to deployment. You're seeing more broad-based, wide enterprise phase deployment across the adoptions. Adoptions are going up, depending on the numbers that you look at. You could see, already 60% adoption rate. Some numbers even put it close to 80% adoption rate. So the fact is that the monetization cycle has started. We're still early in the phase of it. So it's not just what transfer, one CapEx is another person's revenue. Eventually, there is monetization that's already underway.
Yeah, what's paying for it right now? Is it the labor market?
I would say, it's a combination, right? A little bit on the margin in terms of we're seeing already pull back in terms of hiring and headcount reduction at tech. It hasn't hit the broad-based economy yet. And so I think what's paying for it right now, of course, a lot of this is being financed from operations, from cash flows from operations. There's also now capital markets are quite open. The constraint is not capital, right? We're seeing that. We're seeing that even in the debt raise this year by the hyperscale, oversubscribed, 10 times oversubscribed. The constraint continues to be these bottlenecks that I talked about earlier.
Is the excess and the ample liquidity for some of these tech companies the potential constraint for other companies not related to this trend? In other words, do you see clients and are you recommending to them to sell other assets, other loans, other debt instruments, other stocks of companies not participating in this to finance the purchases and investments in the SpaceXs and Anthropics and OpenAIs of the world?
What we have been really focused is really advising our clients to manage concentration risk. So where they have, yes, over the last several years, we've seen like the Max 7 has driven a good portion in the appreciation in the stock market. And now you're seeing a diversification, again, as I talked about earlier, across the AI value chain. So what we've been advising clients is to do, making sure that they have exposure, diversified exposure to these transformation and innovation opportunities. And that includes AI. That also includes electrification. It also includes the longevity that you talked about earlier. So it's not limited. So my point is, it's like the AI trade has and is and continues to broaden out. I think that's an important message, that it's just not one or two stocks anymore. I mean, look at the strong performance this year. It's not the Max 7. It's the memory stocks. It's the packaging stocks. It's the networking stocks, and so forth. And so that's our key message to clients: diversification, but exposure to these secular growth trends are important. They cannot be missed out. These are not cyclical bursts, right? The spending that has happened is not cyclical. It's really structural, and it's an infrastructure story that clients must have exposure to.
The Job Fridays have changed so much, haven't they? They really have. We just don't talk about jobs on Payrolls Fridays. You join us every Payrolls Friday, and the conversation has shifted so much. We spend so much more time talking about tech and AI.
We will start to talk about jobs when
and
it
hardly
starts.
mention payrolls.
Yeah. When it starts impacting the labor market in a more meaningful way, I'm sure that will be the topic of conversation.
In the meantime, how relevant is the number to this market and your call?
Look, in terms of course, the outlook of the Fed, it is important to us. The number, we're watching the unemployment rate. It seems to be stabilizing around 4.3%. We're also watching wage growth, just given the implications for inflation. I mean, right now we know that the market is pricing in hikes from the Fed. We still think that there's a possibility for a cut this year, but of course, inflation is proven to be more sticky. The labor market is important to the Fed call. If we see any weakness in the labor market, then that could cause the Fed to move later this year. But we think that even though December is sort of our official call for the next cut, that could get pushed out into 2027.
I'm actually fascinated for this labor market report. I'm excited to look at the details, and the details have been really interesting. I'm not just talking about wage growth. I'm not just talking about the unemployment rate. But if you take a look at where the gains and losses have come from, the tech sector said last month it planned to eliminate 38,000 positions. That was the greatest going back 2 years to August 2024. You're seeing them say it's because of artificial intelligence. Do you expect this to be a leading indicator of what we can look for in other sectors, particularly the white-collar areas that have been seeing some job reductions on the margin as a whole?
Maybe not at the magnitude that you're seeing it in tech, but historically that has been the case. That's where, technology gets adopted first, right? But you could argue, post-pandemic, some of these tech headcounts got bloated, right? So I don't think it's all AI related. Some of it is just normalization and right-sizing business. Yes, AI is impacting tech. But if you look at the data so far, you're not seeing any sort of wide-based impact to the labor market. Is that the future to come? On the margin, yes. I do think that to some extent you will start to see an impact in the labor markets in the years to come, but it's more gradual. It's not going to be, because at the end of the day, we are still a consumer-driven economy. Someone has to pay for spending, and that's the consumer. So it's a balancing act for these companies as well, of how much you reduce headcount and what impact does that have of overall consumer spending, which ultimately drives the economy.
Apparently the person doing the spending right now is people's parents. Do you see the stat yesterday? It's amazing. Almost half of Americans rely on their parents for financial support, including 33% of Gen X. 33% of Gen X. This came from Northwestern Mutual. 42% of all Americans say they're financially dependent on their parents. 20% of Americans believe they will never be independent.
Wow, the whole wealth transfer.
Shocking?
That is shocking. And sort of the retirement accounts that are going to their children. You lived in Soho. You should have experienced this firsthand.
I did live in Soho, and you know my experience of living in Soho. And it actually speaks to a lot of things happening right now.
Well, I mean, there is the sense.
I'll share a story.
OK, please, carry on.
So when I used to take a day off, I used to walk around Soho. And I used to see all these people that didn't look like they had jobs. And I was like, what do all these people do? How do they afford to live here? This is absolutely ridiculous. And then I thought about it. If you had massive pools of capital, if you were really wealthy and you were supported by very, very wealthy parents, there's probably 3 or 4 places on the planet, if you were choosing a city, where you would choose to live. Which is why we have this massive concentration of wealth in these cities, and within those cities, an even bigger concentrated wealth in certain parts. And then within those cities, when you have certain sporting events, that's why tickets are absolutely sky high, and it's $6,000 to get in just to watch some basketball next week.
I love getting a view into your morning walks and you just sort of get a sense of your psychology during it. To be fair, though, and not just the hyper wealthy, the progeny of hyper wealthy families, but in general, the younger generations don't have access to some of the basics that older generations had, like home ownership, unless they have parents participating. So this has become built into the structure of a lot of families. And with life planning, she kindly said longevity, Nadia, rather than, just getting old, you think about these things.
Nadia, it's good to see you. As always, thank you. Nadia Lovell there of UBS. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. White House officials are clashing over potential loopholes in China chip restrictions. Sources telling us here at Bloomberg, officials are looking into whether Chinese firms took advantage of unclear policies to legally buy servers outfitted with Nvidia's advanced chips. Anthropic is urging AI labs to consider slowing development. The company is warning that systems are advancing so quickly they may soon be able to improve themselves without human oversight. And Elon Musk joined JP Morgan CEO Jamie Dimon pitching the historic SpaceX IPO.
Why SpaceX public now? Because you had choices, you didn't have to. Why now?
We're embarking on a massive new growth phase, and we need capital for that.
Okay, number two.
Another thing is the revenue. I also feel pretty good about the revenue projections. Before, revenue was a little unstable.
SpaceX pricing its share sale at $135 per share to raise roughly $75 billion. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for the update. Up next, we'll get you some morning calls, plus Becky Frankiewicz of Manpower Group with Payrolls just around the corner, live from New York City this morning. Good morning.
The last few months, we've had data that suggests that the weakness in the job market late last year, I think we can sort of look through that. But we're going to be looking for any signs that GDP, consumer spending, is that broadening out beyond just AI and the upper part of the K? And I think the jobs market is the best high-frequency measure of that.
Priya Misra of JP Morgan looking for another read on the labour market 15 minutes away. Your scores into that look like this. We're down by 0.5% on the S&P, on the Nasdaq down by 1.2. The loss is building in tech heading into the weekend. Look out for that. In the bond market, look out for this. Yields still elevated. 2 still around 4. 10 still around 450. Heading into a Fed meeting with a 2-year rate trending above the policy rate at the Federal Reserve. And some people saying that this Fed, quite simply, is too easy. And they're pointing to financial markets, not the broader economy.
You know what's funny? We see this in the market, but almost every bond strategist we talk to says they expect rates to go lower next and that the Fed's bar to hike rates is so high they're just never going to get there. So again, a little bit of a contradiction there in terms of market activity and some of what we're hearing in terms of strategy.
They believe it's a communication exercise. I believe that at the moment it is a communication exercise to anchor inflation expectations. That started with Chairman Powell a few meetings ago. The longer this goes on, though, it becomes more than that. The first thing you do is get rid of the easing bias, you slip into neutral. And you look at the data, you get through summer. And if this carries on, this momentum, and to your point, you end up with a situation, let's say we get to the fall. We're in the fall and you've got unemployment at 4 and you've got inflation at 4. Then you've got a real conversation to have.
Yeah, the tenths of the percentage point matter at a certain point. If you start having that type of correlation, that is what you see before hiking cycles that usually don't end well. Will the Fed be caught so offsides that they have to hike rates quickly and really create much more of an economic issue?
It's the numbers, but the persistence of it. That's what's going to get them more and more nervous as the months go by.
Rather than one blip in some sort of
look, if you end up at 4.2 this morning and everyone changes their call, get a grip. Like, you didn't have an argument to start with if your argument changes on a 10 basis point move on the unemployment rate.
To be fair, given the fact that my mind changes every single day, I think that the data has been really confusing. So people have been flipping around because it's been really inconclusive. Just a fair argument for, if you change your call, it's okay. Come on, talk to us about it.
Oh, no, of course. Come on down. We'll be very kind. Everything's okay. 450 on 10s. Let's get you some morning calls. First up, BTIG downgrading Lulu to neutral, seeing potential for trends to deteriorate further. Elsewhere, JP Morgan putting Qualcomm on its positive catalyst watch, citing positive expectations for its data center revenue. And your third and final call from the team at Berenberg, downgrading CrowdStrike to hold, citing limited potential for upside. One of the blips we've seen in tech earlier this week, not just Broadcom, but that name too.
Yeah, coming out below expectations. And a lot of it, they actually did beat. It's just that people had incredibly raised their expectations after the Mythos moment, hoping that CrowdStrike could benefit, in exponential ways, and there are constraints, and that's what we saw.
It was a rare bright spot within software stocks that had recovered somewhat in the last month or so. Let's talk about this jobs report. It's just around the corner. Becky Frankiewicz of Manpower Group writing the following. We expect continued job growth, but at a slower pace than earlier in the year. The key signal for payrolls is whether hiring broadens or stays concentrated in a narrow set of roles. One of my favourite guests to talk about the labour market. Becky joins us now for more. Becky, welcome to the programme. Let's talk about the broadening out. Are we seeing some momentum? Have you got some good news for us?
Yeah, so first I'd say we have a labor market that looks stable, but feels tighter. And why is that? Job postings are up, John. They're up 11% quarter over quarter, but the time to hire is very, very slow as employers are taking their time to make sure they choose the right talent. One data point for you, last year, it took about 45 days from posting to fill a job. This year, year to date, it's 65 days. So employers are posting jobs, but taking their time on hiring. And in terms of composition, we're actually seeing a change in the underlying composition of the labor market. I heard Lisa mention healthcare earlier. Healthcare has traditionally carried the labor market. It is still the #1 job in demand, registered nurses. It is down 50% year to date, even though it's #1. And we're seeing a broadening underneath that, particularly with retail as we go into the summer months.
Becky, what does that mean to you in terms of the broadening? Is that an optimistic sign, or does that indicate just that there are areas that need to at least just stay even based on attrition?
Yeah, I would say, I don't know if I'd go as far as optimistic, Lisa. I would say it's a stabilization sign. You don't want to see one sector, whether it's tech or healthcare, carrying the job market. You want to see that quite balanced. And we've seen healthcare disproportionately post-pandemic carry the labor market. And so I'm encouraged to see retail salespeople, retail supervisors, and software developers, although declining, are still in #4 position in our country today. And we're seeing AI, the new thing, and I heard your former guest talk about AI. AI now makes up 3% of the job demand in our country. And you might say 3% is quite small. That's almost 200,000 jobs, about equal, ironically, to the number of registered nurses jobs that are open in our country.
We'll get into that in just a minute. I am curious, though, about something that Neela Richardson was talking to us about earlier this week, about how there's an increasing number of part-time jobs. There also are an increasing number of jobs, like you mentioned, in the retail sector, in the manufacturing sector, that are good jobs, but that are lower paying than jobs that are not being created in other sectors. Is that something that you're seeing as well?
Yes, I think on both sides. So first, you talked about part-time. In part, that's being driven by the way that humans want to work, particularly this younger generation that is curating their jobs. And so 68% of Gen Z has a side hustle. And so they have a regular job and then they have a part-time job on the side. In some cases, they may live in Soho like John. In other cases, it's because they have interests that are outside of their core job. So we are seeing this increase in, I'd say, flexibility in people designing their jobs. And yes, we are seeing a growth in some manufacturing jobs, some retail jobs. But I would say job growth in what fuels our economy is always a good thing.
Becky, let's talk about the future and the way you see things shaping up. You're on the pulse of the jobs market right now, but you've also got experience inside corporate America when you worked at Pepsi too. How do you think this is going to turn out? You're looking at the technology and how it's progressed. You know what the incentives are for multinationals, big institutions. Do you think we do go to this terrible place where white-collar layoffs really start to accelerate, or do you see a different path?
Yeah, so I think we're going to see, as we have historically, I think we're going to see introduction of new jobs. I happened to be in Napa a few weeks ago, and forward design engineers were all the talk. What in the world is a forward design engineer? A brand new job that we didn't hear about 6 weeks ago. They're the people who translate between the business and what the business needs from tech and the actual build of the tech. And so I think we will see this transition in roles, like what happens to software developers, database architects are growing. So we'll see a transition. The real question, John, is the timing. Will it be a seamless transition, or will there be a gap that then creates job growth in the future? That I don't know yet, but I would anticipate that the labor market will normalize. But we will see a change in the underlying composition. And I think we're starting to see that already with some of the growth in data center jobs.
So let's circle back to the point that you made about the 3% growth in artificial intelligence-related jobs. Are those jobs just directly taken from other tech sectors, right? Or are these jobs that you're seeing come at the expense of, or do you see people transferring into these areas from, say, business services or other areas?
Yeah, so first, it's 3% of the overall job openings are AI related, and that's up about 800% year over year. It's a really big increase for 3%. Yes, and we are seeing these be adjacent to programmers. So we're seeing a lot of programmers shift themselves into data architects, computer network specialists. Okay, why are we seeing that exponential growth? Because they're working in data centers. And by the way, construction managers are also up with the growth of data centers. And so data centers are quite interesting for a microcosm of what we might see to come of infrastructure build, physical operations, and then AI partnering. In terms of people shifting in, again, I'd say it's adjacent, Lisa, but the tech companies would tell you we don't have enough people with AI-related skills.
Becky, appreciate the time. As always, it's good to see you. Becky Frankiewicz there of Manpower Group. I think that's the ray of light, I think, the hope for the younger generation. You could see this reverse training. I've heard about this, that certain banks now are taking more of an interest in the graduate class because they are much more on top of this technology of the people than the people, some of the people at least, working inside the institution.
You want the AI natives. You want them to come in and help you create agents so that I can get my new role as a news neural net. That's what I think about it.
What is that?
It's a neural net for news. That's what I think I should rebrand as.
Okay.
And I think that
could you briefly describe what that might look like in the future?
Yeah, it'll just be essentially a map of all of these different connections, these different ideas.
Okay.
And it can just sort of blip around, and you can sort of input yours, and then it'll come together, and there'll be my face, the simulation.
And then you'll
speak.
This
is important. This is important.
Okay. That's the future. Thanks, Bramo.
Anytime.
It's hope for us all. Up next, the jobs report. Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. Bloomberg subscriber, does the software upgrade to Bramo 2.0 make her less bearish? If you are going to do that neural net thing you were talking about.
I don't know. It depends on what the inputs are. And frankly, it depends on my feedback loop. If you're bearish, then should I be bearish? If you're OpenAI, if you're bearish, I'm bearish. If you're, Claude, maybe not.
Should you be bearish? Payrolls, just seconds away. Futures pulling back by 0.5% on the S&P. We're down by 1.2 on the Nasdaq 100. With your jobs report, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, it is a bullish day, to say the least. 172,000 jobs were created in the month of May. That is significantly higher than last month's number, although actually we're revised down a little bit, 179. The 115 from last month revised up to 179. Two-month payroll net revision, 93,000 in total. The unemployment rate is at 4.3%. There is no change there. Change in private payrolls, 120,000. Last month revised up to 177 from 123. And average hourly earnings up 0.3 during the month, 3.4% for the year as a whole for the last 12 months. And weekly hours at 34.3, unchanged from before, from the month before. 61.8 for the labor force participation rate, same as before. So a lot more job creation than we anticipated. No change in unemployment. We'll take a look at some of the categories that gained and lost in just a moment.
Mike McKee, I'm not sure I should do the market check. You can guess where everything is off the back of that. Massive upside surprise on payrolls, 172, the estimate 88. Really, really nice two-month payroll revision as well. We're looking at 93,000. Push that through this bond market, bring up the Treasury board, 2s, 10s and 30s, yields up across the curve. 2s up by 5 basis points, approaching 4.1%, breaking back through 450 on 10s, up by 4 basis points this morning. Call it 5. Push that into this, the equity market. Futures shaping up as follows, already pulling back. We're down by 0.6 now on the S&P, negative by 1.3 on the Nasdaq 100. There's a couple of different ways of looking at this if you're the Federal Reserve. That momentum, maybe, just on the margin, getting you start to think more about a tighter labour market. But then you look to the other data points, unemployment and wages. Nothing too scary for this Federal Reserve based on that alone.
No, based on that alone, this is exactly in line. It's not that big of a surprise. However, if you don't think that 1 month of data really matters all that much, take a look at the 3-month average change. And what you see here is that it's the biggest at 188,000 going back to March of 2024. So the rolling average is increasing and would suggest a rejuvenation in the labor market that could potentially give them pause. If they are worried about a weakening labor market, well, maybe they shouldn't be, because nothing in the data seems to suggest that.
Mike, you've got a second look at things. What do you see?
Well, we saw strength in the services sectors that we have been seeing. The same number that comes up every time we see the number of people who are doing the health and social services jobs rise significantly. They were up by 35,000 during the month, in line with the average gain of about 38,000 that we have seen. Healthcare services, ambulatory healthcare services, the helping out of the elderly, up 26,000, while social assistance was up 12,000. Financial activities, the big loser, down 22,000 during the month and is down by 107,000 since the peak in May of 2025. So a job you want to avoid there. Employment in transportation and warehousing essentially unchanged. It's up by about 1,000, although down by 92,000 since the peak in February of 2025. Air transportation, of course, caught up in the war, etc., lost 9,000 jobs, and that is basically because Spirit Airlines went out of business. Little change over the month in other industries, including construction, manufacturing, wholesale trade. The number of manufacturing payroll rose by 7,000 compared to flat the month before. So not much change on the goods producing side, but services pulling everything up. I know that I was talking with Stephanie just before we went on, and she was worried that she was going to be too high. I don't think she has to worry about that now.
We'll get to her in just a second. Michael, thank you. Michael McKee breaking down a pretty fantastic jobs report, the headline level. If you're just tuning in, welcome to the programme. 172, the payrolls number this morning. The estimate, 88,000. That's above everything we've been talking about throughout this morning. The 2-month payroll revision, absolutely fantastic. The 3-month average, which is what Bramo was talking about, 188, is sky high too. So for the Federal Reserve, think about what they've been doing. We've had these so-called insurance cuts. We had 75 basis points of them just last year. And in the statement they put out, there was this so-called easing bias. And what that was really about was the signal to this market that we're having a pause in the easing cycle, not necessarily the end of the cutting cycle. And what the Federal Reserve is shifting to now, and Fed officials have really got on board with this, is they want to articulate a more balanced reaction function, that the possibility for a rate hike is equal to the potential for a rate cut. And based on these numbers, and based on the CPI report that everybody is anticipating next week, you'd be very, very surprised if that easing bias was still in there in 2 weeks' time.
Yeah, it's almost written out already by the markets. Matt Lazzetti over at Deutsche Bank thought of this in a really interesting way. He put out a note a couple of weeks ago saying those insurance cuts, maybe they took out too much insurance, and maybe they need to give back some of that insurance in the form of maybe 1 or 2 more rate hikes. And that might be where they ultimately migrate to in their communication.
Stephanie Roth of Wolfe Research joins us now for more. Stephanie, good morning.
Good morning.
Don't seem to have a labour market problem. Is there an inflation problem they need to respond to?
I don't think they necessarily need to respond in a big way. I think, of course, we have to be watching it. But it doesn't seem like inflation is accelerating in a material way. Now, we have to, of course, keep an eye out on, does this labor market create inflationary pressures? And perhaps that is, the very early start of it. But before that becomes abundantly clear, inflation will probably likely start to cool a little bit. So it will probably all work out from a timing perspective such that the Fed can do nothing. We'll see a labor market that's quite strong. and they can kind of wait it out for a period of time. But of course, the data show that the labor market is continuing to hum along quite well, even though AI is still impacting some of those industries.
Well, let's stay on the potential price pressure coming from the labour market just for a moment. Lisa went straight to the 3-month average, which is pretty punchy at 188, particularly when people are telling us that the break-even rate is closer to zero. So my question would be, just looking at that, how are we able to push through that kind of job growth without generating the wage growth alongside it, given that people are telling us the break-even rate is closer to zero?
Well, so I actually don't think the break-even rate is closer to zero. Our estimates suggest it's closer to 65,000. You saw labor force growth, and this report was in the 80s. So it's possible that labor force growth is a bit stronger than people think in terms of what the steady state can actually be, which then allows payrolls to run higher than that. Now, of course, it's run even beyond that. Perhaps payrolls are overstating to some extent. Household surveys have been a little bit softer in recent months. So that's one reason why the unemployment rate has kind of been steady. I think the message from the labor market is your steady state break-even pace, so the pace that you can go without really generating inflation in a big way, is probably in the 70-ish thousand range, which is likely where the trend in payrolls is actually settling.
That makes sense and explains why we are seeing a 4.3% unemployment rate, why it's steady. It didn't go down, which some people would wonder just looking at these headline numbers. Are you seeing specific areas that do seem to be impacted by AI? And I'm looking at financial services in particular. Again, 22,000 job decline in the financial services industry, and you've seen it really decline in terms of the total headcount there over the past couple of months. Are there other areas that you're seeing as particularly notable for job losses within this?
So you're certainly seeing it in finance, you're seeing it in information, although there was 2,000 decline this month. It wasn't particularly strong or particularly large. One interesting dynamic that has changed in the past couple of months is that professional and business services has stopped shedding jobs. That was a big trend in much of last year and into early this year, but that seems to be sort of moving in other direction. So it seems that perhaps they've done the job shedding for now in that industry, and maybe that's going to be a little bit more steady. What we're likely to see is rolling periods of disruption in various industries from AI. So tech and finance have certainly felt the brunt of it. But the positive AI story would be by the time the next industries are starting to actually see disruption, those industries are already done with that. And you end up with a period of time where the disruption isn't all happening at once, in which case the labor market can continue sort of moving along.
And it's moving along this morning, 172,000 against an estimate of 88K, some really positive revisions and a very positive 3-month moving average. Mike McKee is back with us. Mike, you've got another look at this one. What do you see?
Well, there's something interesting here. John, you were just talking about what the level of unemployment and employment should be given the fact that the labor force is going down. Labor force did rise a little bit, rose by 83,000 in the month of May. That's after a negative 92,000 and negative 396,000 in the prior months. But basically, we're seeing very few people enter the labor force, so you don't need as many people getting jobs. And we see that in the breakdown of where the unemployment rate came in. Employment went up by 149,000 and unemployment went down by 66,000. Neither of those is huge numbers, although the employment numbers reverse a string of drops. And so the unemployment rate falls basically, or stays the same basically because there wasn't much movement on the household side. And the one last point that I'd make here is if you look at the goods side of the report, in almost every category, you see some declines in non-durable goods, in durable goods except for construction. You're seeing people lose jobs, and so it is really sort of a shift from where we had been before, and we're seeing the services side come up now.
Mike, thank you, buddy. Increase it. Appreciate it as always. The 2-year at the moment up by 7 basis points this morning, the 2-year at about 4.12. I want to bring in Jeff Rosenberg of BlackRock into the conversation as well. Jeff, you look at these numbers and the numbers we're anticipating next week as well, Jeff. Are we set for a hawkish turn from this Federal Reserve?
Well, we are, and we have been for some time as the data has accelerated. You know, first we had the acceleration on the inflation side, and really more than the acceleration, it was just the lack of the deceleration on the inflation story. You know, this morning, and I think you guys have honed in on the key number, the 3-month average printing at 188, the combination of today's upside surprise plus the revisions, you're changing the narrative on the labor side. So the combination, the old story was a weaker labor market, an expectation of falling inflation, and we need these insurance cuts. And as you were highlighting Matt Lizzetti's point, maybe they took out too much insurance. Well, that's kind of after the fact because the facts have changed. So the facts that are changing here is a stronger labor market, a fourth supply-side shock in the form of the war, and its impact on oil inflation. And absolutely, we've changed the narrative that's already been in the price. It's going to continue, as you're seeing in the markets here today, and that hawkish turn, as you highlighted. We're going to validate that, with the change in the language in the June FOMC.
Jeff, forgive me, but shifting to neutral doesn't really feel hawkish. Moving to hike and then hike again feels hawkish. Are we going to get that kind of action from this Fed, and how high is the bar for that?
Well, the bar for June is high in that this Fed, wants to move slowly, typically tends to move slowly. And the issue that we're going to have from the Fed perspective is managing the dispersion within the committee. So you're not going to get that clear signal, but the direction of travel is clearly there. The question is, will the Fed get out ahead of where markets are pricing, or are markets going to try to push the Fed? So far, it's the latter. The markets are out ahead of the Fed. And really what we're seeing here, likely to see here, I should say, in the June FOMC is the Fed playing catch up.
Well, and Jeff, this is the key point that a lot of people are making, is that the Fed's behind and the market's kind of leading the charge. And they're looking at the data and they're saying that there is enough labor market tightness to foster inflation going forward, in addition to supply shocks and this existential spend on AI. Would you bet with the market, or would you bet that the Fed has too high of a bar to actually hike rates based on what the composition of the Fed is and, frankly, what the drivers of inflation really are?
Yeah, we're right on the precipice of pricing in a full hike for this year. So that probably feels about right, given where the data is relative to how lagged the Fed is, and not wanting to be in a hurry for many reasons to move towards a hike. And if they can just hang on to the inflation data, not aggressively reaccelerating upwards, and they're going to need a little bit of help there, and they're getting it from the oil price situation. I don't think they're going to be in a hurry to raise rates. And so pricing in more than that, unlikely. The other point here, and Jonathan, you usually say, the first reaction is not the last reaction. There are some kind of one-offs in this labor report that is probably overstating that headline. The market's going to react to the headline, but give it some time to look through. You got a government number in there that looks pretty outsized. You got a leisure and hospitality number that looks a little outsized. No doubt this is a strong report, but when the dust settles, it's really going to be about the gradual strengthening in the labor market, and can you see this kind of stabilization in inflation that keeps the Fed from having to move towards a more aggressive tightening phase? I think that's where we'll get to, but again, it depends on, particularly that path of inflation.
Hey, Jeff, appreciate it. As always, Jeff Rosenberg there of BlackRock. The first move is not always the right move. It's what we often say. This is the first move. Yields are up across the curve, particularly the front end. We're up by 8 basis points on twos, 412. See that move in fixed income. You expect the following move in equities, just a pullback on the S&P, on the Nasdaq, and the Russell this morning. And that's what you see off the back of a really punchy payrolls report.
To Jeff's point, though, when you take a look at some of the details, government jobs increased at the fastest pace going back to 2024 at 52,000. I guess that Elon Musk is distracted, so Doge is getting reversed. A real question here about the sustainability of that. Also, when you talk about leisure and hospitality, 70,000 jobs added. Yes, it is heading into the travel season, and I guess the wealth effect is in strong force because everyone is going to hotels and flying on planes and needs to get beefed out from that perspective. But again, are these sustainable numbers, or are they potentially padding things out a bit?
Final word, Stephanie. At least it's not healthcare anymore. Not just healthcare.
At least it's more the cyclical sectors. And that's what we were expecting to see this year. Is the cyclical sectors were really held back last year by tariff-related uncertainty. Travel, ironically, was one of the big sectors because there's just so much economic uncertainty out there. That seems to be reversing. To Jeff's point, the data are probably stronger than the actual trend pace. There's seasonals that tend to happen this time of year. You tend to see that in leisure and hospitality. You tend to see that in local government. And these are the areas where you saw some of the biggest gains. So I wouldn't take this number at face value and extrapolate that into the future and how far that's going to bring down the unemployment rate. But I think the message here is that the labor market is holding up fairly well. The AI story is probably not one that's going to be an issue for a lot longer than people had anticipated. And at this point, the labor market's not generating inflation. So far, the Fed can just wait it out and see kind of the path of the data in future months. The inflation data is not, on their side, but for now, the Fed can certainly be in wait-and-see mode.
Stephanie, thank you. Stephanie Roth there of Wolfe Research. Big headline just crossed on a Bloomberg terminal, now fully pricing a quarter-point hike by year-end.
Yeah, markets are looking at this and they're running away with it. The leisure and hospitality issue, I just want to point out, this is one of the reasons why it's important to listen to some of the airline CEOs that have been saying that demand is just sky high and they're continuing to see it and people absorbing price increases much more than they had expected. You're seeing that in the hiring rates, too, because if the bookings are increasing, well, they got to beef up their staff to meet it. Gives you a sense of what's building in this economy.
Was that analysis or a promo for this weekend?
It was a promo for this weekend.
Do you want to do the promo for this weekend?
I'm going to Brazil to talk with airline
executives. Sounds awful.
Sounds
awful. Goes to Rio to talk about airlines.
Well, hold on a second. Okay. I'm going for a couple days over the weekend to talk to the airline CEOs. The reason why I find them interesting, though, is because they're the best real-time economists of what travelers are doing. I think that's really interesting.
Is this what you told management when you pitched this trip to Rio?
You think I'm just going to be on the beach?
Who are you speaking to this weekend?
I'm speaking with the Delta president. I'm speaking with the CEO of United, Scott Kirby. I'm speaking to the COO of Southwest on surveillance on Monday. Don't miss that.
Okay.
As well as JetBlue's Joanna Garrity. So it'll be interesting to hear about the different tiers of airlines. I think that's enough.
I'm pleased they've justified your trip. Bramo,
you
off
think
to
this
Brazil.
is a junket? I actually think
feels on the margin.
Really
does it feel like a junket?
It does not feel like a junket.
Sounds like a junket.
No judgment here.
Looks like a junket.
You think so? Over my weekend.
Might be a junket.
All right, really.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Just to recap the jobs report, non-farm payrolls blew past expectations for May. 172,000 jobs added versus estimates of 88,000. This marks the third consecutive month of gains, with the unemployment rate holding steady at 4.3%. The Trump administration is exploring whether the government should take ownership stakes in leading AI companies like OpenAI. Senior U.S. officials reportedly held talks with the major companies about potentially transferring shares to the government voluntarily. And President Trump will be the first sitting U.S. president to attend an NBA Finals game. Trump confirming yesterday he'll attend Game 3 of the Knicks-Spurs series at Madison Square Garden Monday night. New York City Mayor Zohran Mamdani is also planning to attend. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate the update. Up next on the program, we'll set you up for the day and the week ahead. Plus, Yahara's going to come back and break down some morning movers from New York City. You're watching Bloomberg TV.
Doesn't it seem like inflation is accelerating in a material way? Now, we have to, of course, keep an eye out on, does this labor market create inflationary pressures? And perhaps that is, the very early start of it. The data show that the labor market is continuing to hum along quite well.
Really impressive. That was Stephanie Roth there of Wolfe Research. Not just Stephanie, but the data coming in much stronger than expected. 172,000 on payrolls. The estimate was 88. Yields up at the front end of the curve, bringing equities down just a bit. S&P 500 futures negative by 0.6%. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing the chip trade falter this morning, still feeling the effects after Broadcom disappointed. So you're seeing names like Nvidia, Intel, and Micron all lower. And Micron is notable since it just scored a major win after Nvidia CEO Jensen Huang said it was one of the companies approved to supply its advanced memory chips for the new Rubin AI system. And yet losses are mounting on that name, now down 4.5% in the pre-market. Also in the red is Lululemon. Shares are plunging 12.25% in the pre-market after the athletic wear maker cut its full-year outlook, pointing to worsening trends in North America, and management saying that over the past few weeks, it's seen traffic slow, and that's due to controversy around some of its leggings being see-through. And we end on DocuSign. Those shares are also in the red, down nearly 5% in the pre-market. It gave an outlook that was largely in line with expectations, but not enough as these software stocks try to stage a comeback after their AI-fueled sell-off. John.
Yahara, thank you. Thank you for this morning. Appreciate it. Have a nice weekend. Promo time. A new addition to the lineup here at Bloomberg TV. Looking forward to this later this afternoon. Bloomberg Money kicking off this afternoon with Scarlett Fu and TK, two of the very best here at Bloomberg. Scarlett, good morning. It's good to see you.
Good morning. Nice to see you guys.
What's coming up later this afternoon?
So we're going to talk with Liz Ann Saunders of Charles Schwab and Gabriela Santos of JP Morgan Asset Management. And basically what we're doing is taking the daily news flow and folding it into the larger trends and exploring what it means for your personal savings and your retirement. And in the case of today's jobs report, great, people have jobs or we're growing jobs, but wages are not keeping pace with inflation. And we're going to see that with the CPI report next week. So the challenges around building your portfolio and building out your retirement around that. In addition, we're going to talk about, SpaceX, because a lot of employees will come into a lot of wealth very, very quickly. Will they use AI bots to manage their wealth, or will they band together and demand lower fees from human advisors? That's what we're seeing already.
Yeah, that's going to be something fascinating. This idea of, are we all just going to go to bots? I mean, is that something that you keep hearing about, the way that AI is transforming asset management?
It is, and certainly it's democratizing wealth management as an industry to make it more accessible to everyone. But at the high end, people are always going to want that high-touch experience and that high-touch service. People want to talk to people, and wealth advisors in many ways are kind of like therapists.
That's true. They are.
They need
hand-holding, stay invested.
Yeah, exactly. Walk you through, it's okay, don't worry, you don't need to panic.
Bedtime stories to help you sleep well at night. I know.
All I'm thinking is people like to talk to people. It depends which people. It depends who you're talking about. I'm just thinking that
if you're doing your job well, then your clients want to talk to you. How about that?
Some surveillance advice. Hide the tank later on this afternoon. Just hide the tank.
Hide the tank.
Hide the tank.
Okay. Yeah.
The tank.
You'll figure it out pretty quick.
Whoa, okay. This is very inside baseball, but I appreciate this.
Hide the tank. Scarlett Fu, thank you. Appreciate it. Bloomberg Money coming up a little bit later, 12 p.m. Eastern Time, alongside TK. Do not miss that on Bloomberg TV. Coming up on Monday, Cameron Dawson of New Edge Wealth, Chris Harvey of CIBC, the former US Defense Secretary Mark Esper, Abby Yoder of JP Morgan, following a punchy payrolls report here stateside from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.